Good morning, ladies and gentlemen, boys and girls. A very warm welcome to all of you on behalf of ICI Dubai chapter. ICA Amit Khetan extending my heartfelt greetings to our members, guests, and sponsors who have joined for this today's session, Tax and Compliance Marathon Sessions. And we also truly honored to have with us our chief guest, Dr. Yahya Al Ansari, the Executive Director of Dubai Campus's Higher College of Technology, who has contributed immensely education, innovation, and strategic development across the UAE. So we welcome you, sir. And joining us, our eminent speakers, stalwarts in the taxations and compliance, CA Rishi Sapra, I think he will be joining very soon, the founder and CEO of Young Global, CA Pramod Kumarji, the former Vice President of Income Tax Appellate Tribunal, CA Atish Shah, the head of tax GCC at DP World, and our very own also, the CA Arun Saripalli, the partner transfer pricing at PwC Middle East. I welcome all of you on behalf of ICI Dubai chapter. Members, each of them brings not just the deep expertise, but decades of hands-on experience that will make today's sessions a powerhouse of knowledge. The UAE tax landscapes, we all know, that is no longer is in its infancy. Since VAT came in 2018, we have seen excise, custom reforms, and now the full-fledged corporate tax coming in. And adding to that, transfer pricing rules, treaty considerations, and compliance frameworks as well. So the fact is, the corporate tax return filing deadline is upon us, and with it comes the needs of the absolute precision. Mistakes here don't just cost money, that risk credibility, reputation, and growth as well. So that's why today's marathon is so vital and important. And it's not just about the compliance. It's about staying ahead, learning practical strategies to safeguard businesses and to seize growth opportunities in this new era. But before we deep dive into the sessions, I request everyone to please rise for the national anthem of UAE, India, and followed by the ICAI motto. I request it.
जनगणमन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उज्जल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गाथा जनगण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
य एष सुप्रीमो सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्लं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः श्रितः सर्वे तदूनात्यति कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you. Thank you, everyone. Please take your seats. Members, we all know that the FTA, Federal Tax Authority, has steadily tightened the audits, introduced e-invoicing mandates, and clarified the gray areas through multiple circulars and court rulings. And now, the corporate tax and transfer pricing regulations in full force, the bar of compliance has been raised even higher. So for us as a finance professional, this means two things. First, we need to master the technicalities like return filing, treaty applications, transfer pricing documentations, audit responses. And second, we must also understand the strategic dimensions, how compliance can be a catalyst for building trust, safeguarding businesses, and enabling sustainable growth. So that's why today's marathon session has been carefully designed, and each sessions cover a crucial piece of compliance puzzle, from practical corporate tax filing return tips to deeper dive into treaty benefits to navigating the complexities of transfer pricing. And most importantly, these sessions are not theoretical. All the experts, led by their challenges, whether in the FTA, in tribunals, in multinational corporations, or in the advisory firms. So it gives me the immense pleasure to formally open the session of Taxes and Compliance Marathon, an event that reflects our chapter's commitment to empowering members with knowledge that is practical, timely, and forward-looking. Thank you so much. Jai Hind, Jai ICI, and welcome all of you once again. Thank you. As we move forward in today's program, now it's time to hear from the leader who has been guiding our chapter with vision and vigor, and of course, with endless energy. May I request our chairman, C.A. Jaiprakash Agrawal, to kindly share his address with us. Can I have a huge round of applause for our chairman? I know it's a morning time. Can I have a louder one, please?
Good morning. Okay, we are not small in numbers. The hall is large. Okay. Perfect. How does it feel coming back home? Today the feeling is same, coming back to the same location which we were doing it, I guess 10 years back. After that we were not able to do it. Now after a decade, coming back today to the same location is like coming back home. Thank you, sir, for allowing us to come back home and be there. Can I have a round of applause for HCT to allow us to come back and have the events back here? Marathon, a long race. And yes, considering today is the month of September and roughly around 80% of the companies need to file first corporate tax return in this month, this is marathon. For every practicing chartered accountant with long office hours, unending phone calls, and non-stop client emails. But yes, we all are determined. We all are determined to complete this race by 30th September for all our clients. And we will do it. While we are doing our part, our nation is also calling for help. Punjab, Himachal Pradesh, Jammu and Kashmir, Uttarakhand, all are experiencing floods, and immense hardships is being faced by countless families and communities back in India. During these times, we chartered accountants need to show compassion and collective action. And therefore, our parent body, our alma mater, ICI, has launched ICI Flood Relief Fund 2025 in India. The email has come to all of you, all the members of Institute of Chartered Accountants of India, by our own president, C.A. Charanjot Singh Ji Nanda, to help request us to support all families and communities in India in whatever small effort of act of kindness we can do. Please check your emails, and whatever best you can do for our families and communities back in India, please do that, because at the heart, we are Indians. Now, moving on. Today, as I said, is special for me. Today, we are starting a new journey with Higher College of Technology, which we ended 10 years back. A collaborative journey, a journey of collaboration between older and younger generations. A collaboration where strength collaborates with wisdom. Strength of young generation of students of Higher College of Technology with wisdom of our chartered accountants. And when this kind of collaboration happens, it starts with a small sparks, and as it progresses, it generates breakthrough innovations. Let me thank the visionaries who saw this and enabled this collaboration. Dr. Yahya Al Ansari, Executive Director, Higher College of Technology, Dubai and Alain. And he is also our chief guest today. May I invite you, sir, on the stage to share a token of love and say thank you by sharing a bouquet with you. May I now invite Dr. Kavita Shah, Associate Dean of Academics, Higher College of Technology on stage, and request our Vice Chairman, Rishi Chawla, to escort her to the stage, please, and give her a bouquet to share our thank you for allowing us to do events here. May I invite Dr. Amal. Amal is already here. Dr. Amal. I guess she's on the way. We'll do it afterwards. May I now invite Dr. Avnish Jomode. Avnish, Assistant Professor Business, Higher College of Technology, and our own member, he's a chartered accountant, on stage, and request our Secretary, Amit Khaitan, to escort him to the stage, please, and give him a bouquet to say thank you. The photo will be incomplete without a person who did all. Okay, I'll have something which I'll say afterwards. But can you join Ashna as a treasurer to chapter? Our Dr. Amal is not here, for a group picture. Sir, कभी-कभी क्या होता है ना, thank you Dr. Yaha and Dr. Amal, but I will request, this is a historic moment for me. May I request all the faculties and students of HCT to join us on the stage for a group picture. All the students who want to come on the picture and faculties can join us, because we are creating a memory here. After 10 years, again, when you see that yes, this collaboration is part of is talk of the town, then you will remember this picture कि हम भी history में शामिल हैं. All the faculties and students who wants to be in picture can come up for a group picture. Members, एक बार ताली बजाइए, घर वापस आए हैं, इनको भी पता चलना चाहिए. They are doing an event with ICAI, Institute of Chartered Accountants of India, Dubai chapter. एनर्जी हम में होनी चाहिए जो पता चले कि हम दुबई चैप्टर को रिप्रेजेंट कर रहे हैं. And finally, my committee members, आप निराश मत होइए. We need a picture with the committee members as well. Committee members can come in. All my committee members, all the 5 pillars, मेरी army, please come on the stage for a group picture with Dr. Yahya. And since we have past chair here, Jan sir, please come on the stage. Any other past chair? Thank you, Dr. Yaha, Dr. Amal, Dr. Kavita, and Dr. Avnish for all your help and trusting with us. I can only promise that if India-UAE partnership under SEPA agreement can result in over $100 billion in trade currently, ICAI Dubai and HCT partnership will brighten the future of both countries in the field of education and will be instrumental in bringing change in the world where peace will prevail. Because someone has rightly said, education breeds confidence. Confidence breeds hope. Hope breeds peace. That is my aim, and that is what this collaboration will do. Talking about confidence, one person from my board, I told you I will talk about it, person from my board who was confident and constantly working for last 6 months on enabling this collaboration. Started in the month of March when the new committee came in. And for last 6 months, continuously, this board member, along with Dr. and CA Avnish, pursued this. And result, today we have this as a reality. And if you think that if it's 6 months of continuous persuasion and then we are having this, she deserves a round of applause. Can I have a round of applause for Treasurer CA Ashna Mulgaonkar? Now moving on. This collaboration already started last month with last event where students from HCT attended our event on future of audit and global consultancies. The event helped them to understand where audit is moving, what is happening on technology space in relation to audit. Wait, why I am saying all this? Let me invite one of the students who attended this session last time, and let's welcome her with a thundering round of applause and a wide smile on the face, because she should feel that she is sharing her experience with an extended family and not with professional chartered accountants. Give a round of applause for Fatima Khan to share her experience of our session last time. Welcome, Fatima.
Good morning to our chief guest, Dr. Yahya Al-Ansari, Honorable ICAI committee members, distinguished speakers, and my esteemed faculty. My name is Fatima Khan, and I'm a student at the Haya Colleges of Technology. I feel privileged to be here today. First of all, I would like to thank HCT and ICAI for giving me this opportunity. Opportunities like this remind us students that we're not just studying in classrooms, but also learning directly from the leaders who are shaping the future of our profession. One such opportunity for me was learning directly was attending the Future of Audit and Global Consultancies Conference, and I would like to share a few key insights that I learned from that event. One of the inspiring messages that stayed with me was highlighted by Mr. Clive Mukundiwa and CA James Matthew. It was about the importance of dreaming big and aspiring to build audit firms that can stand alongside the Big Four by benchmarking ourselves against their standards of excellence and joining hands with the many individual partners and firms across the MENA and Pan-Asian region. We can build a much stronger global presence. Another important takeaway was about the role of AI and auditing and analytics in auditing. In my auditing classes, we often discussed how it is practically impossible for an auditor to check each and every single transaction or account. But with AI, this limitation is no longer there. Traditionally, we relied on sampling, but now we can scan entire datasets completely by AI and quickly identify outliers, making our audits more thorough and reliable. Machine learning also adds another layer of support. Supervised machine learning can help auditors who are already familiar with the industry by checking entire datasets for compliance and fraud. On the other hand, unsupervised learning is especially useful for auditors who are new to an industry, as it allows them to combine their audit knowledge with AI's pattern recognition to achieve efficiency and accuracy. Of course, no tool is perfect. Generative AI, for example, can never be 100% accurate. This is because it relies on existing data, which itself can be inaccurate. There are also valid concerns about data privacy, but I found it reassuring to know that this can be managed. For instance, a company may classify 5% of their data as highly confidential. The auditor can review those manually, whereas the remaining 95% can be processed by AI and analytics software. This way, we can balance innovation with technology. For me, the biggest takeaway was that the auditor of the future must combine their professional judgment with technology. This is not just about efficiency, but also about reinforcing trust and transparency in financial reporting. I would conclude this by once again thanking HCT and ICAI and the esteemed speakers, including CA Rajiv Gupta, CA Vaishal Doshi, Mr. Clive Mukandiwa, and CA James Matthew for sharing such valuable perspectives. A special thanks to Dr. Avaneesh Jumde for organizing and guiding us, and to all our faculty for continuously supporting us. Thank you.
Don't you think she deserves a big round of applause rather than such superb? Thank you, Fatima. The youth of today are the leaders of tomorrow, and we can see a leader in you because the confidence with which you spoke, I did not have that confidence when I was a student. Thank you very much for that. And in meantime, Dr. Amal has joined us. And let me invite Ashna Mulgaonkar to welcome Dr. Amal with a bouquet on the stage. Dr. Amal, don't be surprised. Give a round of applause for Dr. Amal. Perfect. Now time to move on and see the calendar ahead before we jump into the session. After this event on 28th September, we are planning something on Investment Summit, and it will be a full day conference starting at 10 a.m. till 4 p.m. This will be followed by 12th October event on Pillar 2, minimum global tax at 5% for MNCs in UAE. This will be happening on October 12th. And then two big events, which we have already announced. 2nd November will be Diwali, where families will come together to celebrate it. And 22nd and 23rd is our flagship event of the year, that is annual conference with the theme Udaan, empowering your dreams and elevating your future. This is the calendar. Now let's talk about this event. This is the 6th session on corporate tax and transfer pricing in last 6 months. So precisely, your committee understands the importance of a new regulation in the country, and therefore we have been proactively arranging the session on an average every month on this topic. In taxes and compliance, this is the 8th session, including online and offline. And you know the ExCom who has been doing it. This year, as I told you, I am not doing anything. The entire committee is doing it. This taxes and compliance was headed by none other than CA Sanjay Gagrani, and he has been instrumental in conducting 8 sessions in last 6 months. Trust me, it's not easy. तो तालियां तो बनती है, इस रो से तालियां ही नहीं बज रही हैं. Okay, now formally, I come to a conclusion. I'm really interested in the last bench, that last row. Sir, इतनी seats खाली होने के बाद आपको what does it inspires you to take that seat at the end? I will ask you personally when I come there. Let me move on with the sessions right now. Now time to open the sessions, and before secretary comes and invites our chief guest, Dr. Yahya Al Ansari, for his chief guest address, let me have a surprise session for you all for 10 minutes on a strong automation tool on taxes. This is called TaxMate. In morning, when they approached me, and I like the idea that when everything is getting automated, why not taxes? Why we cannot automate taxes? Therefore, our sponsor SBC, along with FAME, has come up with a new tool called TaxMate. So let me invite our own member, who has been instrumental in also giving the sessions on corporate tax, Neerav Ji Shah, on the stage, and let's see the automation tool for next 10 minutes and understand, can taxes be automated? Give a round of applause for Neerav Shah.
Thank you, Mr. Chairman, for the surprise session. As we all know that we are entering the era of compliances. Compliances are new in this part of the world. It's not new elsewhere. So what we have thought is that let's introduce you to one tool that we have been developing for last 5 months along with few software engineers, and making sure that while you are doing compliance, let's not forget that what is more important is the risk management of that compliance for the corporates and for everybody who is filing it. So I'll not take very long, but I'll just briefly introduce you to the tool. Let me first play a small video.
Greetings. I am TaxMate, the future of UAE corporate tax compliance. Not just software, but a robot built to compute, guide, and protect your business. Today, businesses face errors, delays, mismatched filings, and endless rework. Traditional tools break under pressure. Tax teams and consultants deserve better. Upload your trial balance, and I compute in minutes. I create instant position papers, transfer pricing files, and FTA-aligned outputs. My AI alerts, audit trail logs, and maker-checker workflows keep you safe, smart, and stress-free. For CA firms managing many clients, for businesses filing their very first return, I adapt, I guide, I deliver. My advantages? Faster, minutes, not weeks. Smarter, AI-driven, audit-ready. Safer, built-in compliance and controls. Deadlines are near. Mistakes are costly. I am TaxMate, automating corporate tax compliance, empowering tomorrow. Welcome to the future.
Thank you. I will now just give you a small overview of what we are trying to achieve with the software. So those who are filing the return now are very well aware that the current state of the Emara Tax portal, which is used for filing, gives you this challenges, that there's a long loading time, the navigation is not intuitive, there's manual trial balance mapping you need to do, no API integration, no option to even download what you are choosing and filing, right? And then no offline filing utility. There's no multi-user access. There's only one login and one password for every company that you have. And therefore, it's a limited version control, and therefore, you face inbuilt challenges with this. So what we are trying to do is that with this tool, we are giving you an automation and API integration that you take trial balance from whatever system that you are using, upload it in the tool will automatically map it. Of course, for the first time, you'll need to check the mapping is correct or not, but you have that. And then if you are using the same codes for all your group companies accounts, you can easily do it again and again without any errors, right? Then we can create a multi-user role-based access. So for a larger group where you have different verticals, one vertical is handled by one or two people in the finance team, the other is handled by few other, you can give them separate access for each corporate entity or each return that you are filing or each group that you are filing. You can create an entire audit trail, who created what at what point in time, who verified it, who checked it, right? So you have entire data available on that basis. Then we have entire documentation and compliance support, that once you finalize your final computation return that you are filing, we will generate a basis of preparation with giving references to X clauses and whatever position that you adopted. And this file will be then available for you for any future reference. Why you selected a X amount, why you did not put Y, what happened at that point in time. So we have that entire trail, and you have that basis of preparation document available to you all the time for each return that you file, right? And then you can download that soft copy and keep it for you. Today in Emara Tax portal, you get an acknowledgement number when you file the return. You can input that acknowledgement number to this computation, make it final, and therefore nobody can change that finalized version, Therefore, it has offline preparation facility. It gives you scenario planning because you can do different options internally for you to evaluate the impact that you have. And then you have centralized compliance dashboard also. So if you have multiple companies within the group, you can see what companies have been filed, on what basis, what are still to be filed, who is still working on it, and what's the timeline. That entire ability is there within the tool, right? So this is what we are offering you as part of this tool. Now, this is the main issue that we face today, which is what we are trying to address with the tool like this. Data storage, unmap, manual correction, navigation, adaptability, all of this can come in. And these are the main benefits. This automation of the complex calculation. It gives you position paper from a risk management point of view. It gives you audit ready records. It has acts as a central repository from now to whenever you want it to be. And it's AI and decision support based because your trial balance gets mapped through AI. We have a inbuilt tax repository, as we call it, in the tool, which has all the law, all the cabinet decision, all the guides, everything available to review. But also you have a chatbot. You can put in your query, and chatbot based on those resources which are in the tool will give you the response. And again, we have worked on this for a very, very long time, last 6 months, on making it almost error-free. But of course, there will be teething troubles. I can't say it is going to be 100% accurate because no software can be, So that will remain. So this is the journey that you log into TaxMate, you add your companies. Now, adding companies, if you have already created your corporate tax registration, the detail that you file for corporate tax registration, if you can populate in one Excel and upload it together, all the companies will be created with the same information. And all those will be auto-populated wherever required, Then you can add users who has right and control, who is maker, checker, and everything, and define who has access to what. And then you can add your tax period, and then you can select your reliefs, elections, adjustment, upload your trial balance, and there your computation will be ready after you answer the screening questions, which are all based directly from the corporate tax law. So this is a very, very customized tool linking to each screen that pops up on MRA screen, MRA tax portal, for asking for all the detail, exactly the same formats, and it pops up everything and computes and gets everything for you. And then you can review, you can save the final output, and then only hitch that we have today is that from the software itself you cannot directly go into the login and file because that facility is not allowed by the MRA tax portal. If tomorrow they'll start having an ability to give an API for that, we'll create that output from here. But at the moment, you will have to populate this, finalize this, and then go into your login and fill it in exactly as per the same, and you have your data ready for that purpose. So it's not a replacement for the MRA tax portal, but it's an entirely in-house tool, more for your risk management and for retrieving your data and keeping your data available to you, because your audits are not going to come today. They have to come in next 3, 4, 5 years. And therefore, at that time of audit, if you are going to sit and ask for data, how are you going to get that? In corporates, people change, the team change, and therefore your dependency on those people and team is no longer there. Everything is available in the tool at one click, and everybody is aware where it is. So this saves a lot of time, effort on the part of the in-house tax team, but also gives you an ability to have data access and records for that entirely available to you at your click of your button. Of course, it's a complementary positioning with the MRA tax portal, and I'm not going to highlight that much. And I'll just leave it at this, and then there's one more thing. So its computation engine is aligned with UACT law, automated business basis of preparation generation so that you have an FTA ready document. Smart validation, it flags mismatches, and a transfer pricing module will be integrated. So you can upload all your transfer pricing files and benchmarking data along with it and keep it available, and you can do scenario planning and audit tail, and transparency is available to you. Right? So these are all the features. Again, I'm not going to bore you with it. You can get in touch with us at a later stage for that. There's one more special announcement that I have, and that's also a surprise. I have been fortunate to author a book on UAE corporate tax, as you all are aware, which has been in the market for last two years. We have already done 2 updates to that. We are doing a 3rd update, which will come in soon. But in the meantime, I have now authored a book on UAE transfer pricing. Transfer pricing being a concept which is very, very subjective, but it's very, very, very well used by multinationals for many, many years. It's a new concept here, and therefore we thought that we'll put together a compilation, a book, which covers everything that one wants to know about transfer pricing in one single database or source, with plus each of the concept. We have then given illustration, examples of how you are going to apply that. All the transfer pricing methods, we have given example in what cases and what scenario it works well. It has limitations, so it does not work well for something else. And all of that is captured in this book. This book will be available to anybody. You have a QR code on the side. You can click on that, or there is also a standee outside from where you can click on the QR code and place your order. Taxman is a publisher based in India. We have obtained a permission from UAE Media Council to publish and distribute this book here. Once you place an order, the courier will come to your address directly. So it will be coming to you. The book will be ready in about a week's time. So I will encourage all to please go and take your copy. So I would now invite Secretary Amit Ji to please come and take forward the session.
Thank you, CA Nirav Shah, for launching that TaxMate. I think that is going to help a lot of professionals. So a big 2 thanks to both the chairman, CA Jaiprakash Agarwal, and of course, CA Nirav Shah. Can I have a thunderous one, because 2 thanks. And yes, our chairman has given us a surprise, not in a materialistic, but yes, in the knowledge base. So I have the 2 surprise for you. Not in the knowledge, it's something like materialistic. How many of you loving the ultra luxury brands? You can raise hands. Wow. It's slowly coming up. So if you have the ultra luxury brands, our one of sponsor, Young Global, is conducting the 2 raffles for the Gucci card holder. So if you really love those ultra luxury brand, you can just go to their kiosk or booth and drop your business card, and you could be the winner. Now the second surprise. How many of you are the music lovers? Almost everybody, yes. So another sponsor, the Windmill, they are also conducting a raffle draw. They are giving away a JBL speaker, a very good brand. So again, you can drop your business. Both the raffles we are going to do in the end of the session. So try your luck, you could be the winner. Moving on, we are indeed honored today to have our chief guest, Dr. Yahya Al Ansari, the Executive Director of Dubai Campus and Higher College of Technology. So his presence, your presence, sir, truly enriches this tax and compliance marathon. And to formally introduce Mr. Yahya, I would now like to call someone who is very energetic and a key pillar of our managing committee, our vice chairman, CA Rishi Chawla, to take us through the inspiring journey of our chief guest. Can I have a thunderous round of applause for our vice chairman?
Thank you, Secretary Saab. Thank you, Chairman Saab. And thank you for SCT. I must say, it really feels like home. I think they need a really thunderous round of applause. I will call Mr. Our Ansari as our professor. I was talking to him that he has been one of the first UAE national to do a PhD, and it's a great thing. It's an honor to have you with us today. All right. While there is so much to say about, So I want to say today is not just another seminar. Actually, it's the session where the rubber hits the road. We are exactly about 17 days from one of the most important deadlines which UAE business is going to face, which is the corporate tax. I think most of the businesses are following 31st December as the deadline. As most companies follow 31st December, the first corporate tax return is just round the corner. It feels like the final lap of marathon. I think our chairman has picked up a very nice word, marathon. So I would say this is the final lap of the marathon. Some runners are pacing well, some have already filed and celebrated, and some are still trying to look at the Imara login portal. Like every long distance run, we need energy boost. Whenever for the marathon run, you really need that last, like a banana or energy drink to really push through the marathon run. So this session is just like that energy boost session. We're gonna give it a big push. We have great speakers with us who are gonna really push us through this session so that we are ready to file with confidence. And to officially start the session today, we are joined by a very special guest today, and it's truly an honor to welcome him with us. While there is so much to talk about his journey, one thing that really stands out is this. He is the first Emirati to earn a PhD in strategic and innovation management. I think this itself needs a big round of applause. First of all, PhD, when we think about PhD, you have to really go do something new for the world. And that to be the first Emirati to do that itself, that's one leap forward. That's a great thing. And such an honor to meet him today. He currently serves as the Director of Higher Education of Technology for Dubai and Al Ain, and has over 25 years of industry experience before stepping into leadership in higher education. His combination of industry and academic leadership positions helped him as a true leader in bringing theory and practice together. I think that's pretty much explained also today's session, where we have read all the theories. Now is the time to hit on the practical side of things. His research includes influential studies such as strategic and business transformation and environmental determination of open innovation in Dubai SMEs, which reflects his commitment to unlocking innovation and growth within the UAE ecosystem. So without taking much time, please join me in welcoming with a big round of applause our chief guest today, Dr. Yahya Al Ansari, onto the stage.
Good morning, ladies and gentlemen. I feel humble standing here, but I would like to thank ICAI, the chairman, Mr. Agwaral, the team, and all the speakers and who's in this hall. When the vice chairman introducing me, it reflects a lot of memories, It took me years ago, when you start in life and you want to do something different, you want to be different, things are not easy. It's not like 1 + 1 = 2, or 1 + 1 = 1, as the business said in these terminologies. I remember 40 years ago, a long time, I was sitting in my grandfather's house, and he said, Yahya, what do you do in the summer? I said, I don't know, play football. He said, no, come to my shop. It was an old shop. Then I saw him having a book, and he's writing a name of a person, a date, in dirhams, minus a plus, whatever. I said, grandfather, what are you doing? He said, anybody will come to my office and buy something, I have to record it. You call it now an accounting ledger, right? I'm not mistaken. I said, can I help you? He said, no, you're too young to look at money and numbers and all of that. So I start to like numbers. I'm good in math. I got the highest score in high school in math. It was out of 300. I got 298 in my high school. So, thank you. So I love math. So he opened the door for me to look at numbers and math and all of that. So after that, I went to his shop and I said, "Grandfather, can I look at that book? I wish I kept that book. I will show it to you today, but I don't have it." I said, "Grandfather, I've noticed there is a wrong number here." He said, "How do you know? You are too young to tell me what is right, what is wrong." He was very strict, businessman. I said, no, look at your book. So when he looked at his book, he noticed there is something not right in the calculation. So he liked that. So I gained confidence. So next time he told me, "Okay, can you write, this person came to the shop and bought this and he has to pay 100, but he bought me 60 and 40, he has to pay it after 1 week," and all of that. But I said, "Oh, that's nice." So I started gaining confidence. However, my direction was not in business to start with. I went to health science, medical technology, and all of that. Then around early 2000, I was driving my car and I said, "Yahya, why don't get into business? Why you're always in health science looking at, different, God bless you, different diseases, different diagnoses, different. I said, "Okay, let me go and do my MBA." So when I went to do my MBA at that time, I was sitting in an accounting class and a finance class. I said, "What are they talking about?" If you come from a science background going to there, so what are these numbers? People are talking about accounting and financial accounting, and lately we have taxes in the UAE, but we studied the US taxes, the other Japanese taxes, and etc. So I said, wow, that is something I need to learn. Here where I exit my current job at that time, and I went to the market, Dubai Holding. Then we start looking at different companies, the growth, companies entering the market, company exiting the market, how is their strategy, how is their investment, and then I start to understand what is this business about, what is this field is about. So I really, how can I say, I'm honored to stand here in front of all of you with full of knowledge and experience about all these numbers and taxes and accounting and finance, because if you think about it, the base of the companies is your finance. The base of your companies is compliance with these accounting numbers, about honesty, about quality, about integrity. No matter what you do, you need integrity and honesty, and you have to look at the numbers correctly. And that helping the economy of the United Arab Emirates, helping the economy of India, how to move forward, because you as a company, individual, you're honest, you have integrity, you're complying, you want to move into the future. So I'm really happy to be here and to see all of you are really adding to the field of finance and accounting. I know the accounting people, they don't like to say finance first, and finance people, they like the accounting first, but I will put you together as one family. So I'd like to welcome you in the Higher College Technology. It's really an honor to see professionals like you. Our faculty and students are learning a lot. I will tell you a final story, then I will wish you all the best with this conference, and I hope to see more conferences in the future. I was driving my car in 2006. How many years now? More than 18 years. Something like that. Then something triggered my mind. Said, Yahya, you looked at science, you look at the business, how can you put them together? What do you think came to my mind? And if you have a science background and you start having a business, understanding, what do you think it will come to your mind? How can I put them together, right? Then I said, okay, let me put them together through something called innovation, critical thinking, experimental, whatever. I need to put them together. Then I went to my manager and I said, Mr. Manager at that time, I'm going to go and do my PhD. And he said, what are you talking about? I said, yes, I'm going to go and do my PhD. He said, in which field? He said, I want to do innovation. In 2006, no one was talking about innovation. What is innovation? What is this concept where innovation, incremental innovation, radical innovation, open innovation, collaborative innovation? What is this? Remember, yani, long term. I start applying for universities. I'm not going to mention the countries, but I start applying. I got rejected 10 times. You know what is 10 times? You file your papers. It's like your tax, you know, you want to file your papers and say, no, reject. You have to correct. It took me 3 years to reapply 10 universities, and some of them are top. I'm telling you, no. Don't do it. You're not good enough. This is not your time. Then I was playing in the net, and I saw a university in Australia. And I still remember this person, and I pray for him almost every day. His name is Dr. Shankar. He was Australian, Malaysian background. I wrote him, I said, Dr. Shankar, it's been a while. I need to do something different in my life. I want to add knowledge to whatever is around me. Would like to take me as a PhD candidate? He said, I will call you in 1 week. So he called me in 1 week. On the phone, I remember. You know, Teams and Zooms was not a hot thing at that time. He said, Yahya, I will take you as a PhD candidate in one condition. I said, what? He said, if you will get 2 A's in the courses you're going to take. If you get 2 A's in the course A, take A, course B, take an A, about research and methodology, I will take you. I said, Dr. Shankar, I cannot come to Australia. I'm booked with my family and my work. Can I do it online? He said, we don't allow online. 2006, what is online? But I'm going to talk to the university to open the door for you. So he opened the door for me to do it online. And I got 2 A's. And that concept opened online for other students to come after me at that university. So I was very happy the door was open. So what I'm trying to say is technology is coming to you, you like it or not. And you've seen the TaxMate. That's not something you want to avoid. I'm going to close my door. I'm going to close my window. I'm not going to deal with technology. You like it or not. But I'm sure you are very creative. You are very smart. You use technology the way you want, so technology will not replace you. It's not about you replacing you or replacing technology. It's you are the one who's going to tell technology what do you want is going to happen after 1 year, 5 years, 10 years. If you let it the other way, you will lose who you are. So I was talking to our mentor sitting behind the chairman. It's all about you as a human. If you keep your honesty, your integrity, your creative thinking, your future for you, for your company, for the humanity, you're going to say to technology, I want A, B, C, D, coding, whatever, then I'm going to evolve you. You're a robot, you like it or not, I'm going to tell you what you have to do. And that will keep the knowledge flowing. I don't want to take your time. I'd like to welcome you here. I'm very happy and honored to be here today, and I really wish you all the best with this conference, and thank you.
Thank you so much, Dr. Yahya, for your inspiring words and, first of all, for gracing us your presence today. And your insights truly add the immense value to this gathering. I still remember when we were having the conversations outside, no matter how far we are going in innovations and technology, we always should stick to our basics. I think that is personally something for me to take away. So thank you so much. And I now request our chairman, vice chairman, and along with that, he just mentioned the mentor, C. Nareji Sharma, to please come on the stage and to present a memento on behalf of all the members and ICAI Dubai chapter. Once again, thank you so much, Dr. Yahya, for your gracious presence with today. Thank you, Nareji, thank you, Chairman, and thank you, Vice Chairman. Now, moving into the technical heart of today's marathon, our very first session. We all know that the transfer pricing has become one of the most closely watched areas in the global taxation. With the UAE's new regulations, documentations requirement, and increasing audit preparedness, business can go no longer afford to treat transfer pricing as a mere compliance box. It is now a strategic area that directly impacts profitability, risk management, and cross-border creditability. And to take that sessions, we have our speaker, CA Rishi Sapra, and to formally introduce our first speaker who will guide us through the subject, may I now invite our treasurer, CA Ashna Mulgaonkar, on stage. Can we have a huge round of applause for CA Ashna?
Good morning. As we all know, today is a very special day. We are hosting the event where youth minds are flourishing. Speaking of one such mind is Mr. Rishi Sapra. Just a couple of years back, I still remember when he started his entrepreneurial journey. I don't think many knew him that time. I went to his office where he started that journey from. He told me one thing, Ashna, I'm starting here because that was the first client that he had, and he started it from that place. So that is why he had taken a small place there. That's how humble beginnings start. And just within a couple of years, you can see how far Rishi has come. But he never stopped dreaming big. And today, it actually feels surreal to introduce him as Mr. Rishi Sapra, who is just in a few years truly gone global. It's inspiring to see how far he has come. And Rishi, may you all share a secret of how to stay young in spite of going global. He is the founder of Young Global. He's a chartered accountant with 15 years of corporate tax and transfer pricing experience. He has worked on all the fields in countries with Netherlands, UK, and India, working with the Big Four and Tier 2 firm. His experience has dealt in a wide range of tax aspects, including review of supply chain and business model. He has worked on free zone complexity, transfer pricing, designing, structuring. Oh God, that's a long CV. Mr. Rishi, very impressive. So just to sum up in a few words, in the hall of Higher College of Technology, where young dreams take flight, we celebrate a journey that turned youthful spark into global lights. So today, without taking much time, I welcome Mr. Rishi Sapra.
Hi, good morning, everyone. Thank you all for coming in over a Saturday for listening into the UAE corporate tax and transfer pricing rules. I truly welcome you all. Thank you, Ashna ma'am, for the great introduction. I think you were the first one who I spoke to before I was starting my entrepreneurial journey, and there are so many people today. It's very nostalgic. Everyone who supported me when I started, and big thanks to ICAI. We cannot give back as much as we got from them throughout our life till now. So, well, today what we'll do in the next 40 minutes we have is to guide you through some practical insights on the various pain points we still see in the UAE transfer pricing framework. Now, we are just 2 good weeks away from filing our first corporate tax return. And based on the data flowing in from various forums, seems like 80% of the businesses have to file their return by the 30th of September, with some filing in December as well, for whom the financial year end is March. So as and when we speak to our clients, we still do get some pain points, some challenges. So the idea of the presentation today is to provide you some practical insights on the transfer pricing compliance framework, which is live in the UAE. And also, how did we see transfer pricing evolving in the various other countries in the Middle East, such as the Kingdom of Saudi Arabia, Egypt, Jordan, Qatar, etc. Just going with the basics, in terms of the transfer pricing disclosure form, I'm sure most of you would be knowing by now what does it mean, who is required to fill in this disclosure form. But just to refresh the basic and set the stage for further deep diving, transfer pricing disclosure form is required to be filed for related parties and connected person transactions, and they are subject to certain thresholds, and the thresholds are different. So in the UAE, the tax law seems pretty simple on the face of it, but in a sense it's quite complicated. We have three types of tax rates flowing in: 0% for relevant businesses, 9%, and 15% now with the introduction of Pillar 2. And in terms of transfer pricing as well, the complexity doesn't reduce. There are quite some thresholds for preparation of transfer pricing documentation, for filing the transfer pricing disclosure forms, which are as follows. So if in 24, for any organization, the value of related party transactions exceed 40 million dirhams, then you qualify the first threshold, which opens the window for you to disclose certain related party transactions, which in a particular category exceed 4 million dirhams. Now, this is the threshold for related party transactions, but there is another threshold for connected person transactions, which is basically if the aggregate value of each connected person transaction together with your related party exceeds 500,000 dirhams in a particular year, then for each such connected person, there has to be a particular disclosure. We will not go into the details of what needs to be disclosed. That has been discussed in the previous sessions. But basically, we will touch base upon some key points. Now, as per us, the biggest pain point in the UAE, which was not so much prevalent in other countries because most of the countries have personal income tax, is connected persons. Now, connected persons, in terms of definition, we have to see what that basically includes. It says owner, director, or officer. Now, the definition of owner is that any individual or natural person who has an ownership interest in the taxable person, which is the juridical person, the organization, so as to say, or that owner controls the taxable person. Now, there is a definition of control in the tax law, but in terms of the ownership interest, they don't define what is the ownership interest when you talk about a natural person. Someone owning 1% could have an ownership interest, 20%, 40%, 50% or above, definitely that person will qualify as a related party as well. Now, the second thing comes up to who are directors or officers. There is no definition in the corporate tax law on directors or officers, so we look for guidance. The first guidance we allude to when we are looking at the definition of directors or officers is IAS 24, International Accounting Standards 24, which define key managerial personnel. An analogy can be drawn to the directors or officers from the key managerial personnel in IAS 24, which says that KMPs, the key managerial personnel, are those people who have the authority and responsibility for planning, directing, or controlling an organization. Now, thinking out loud, these people could be the C-levels, the C-suite, the directors, chairmen, those who are in the MOAs, AOAs. But then we could also refer to the commercial companies law, which has been in existence for quite some time. Now, we are not saying that it might be fully relevant to the corporate tax law, but again, a directional outcome looking for some guidance. The commercial company law basically defines directors, executive management. Directors basically mean their board of directors, chairmen, managing directors. Executive management means CEO, managers, and their deputies. So what does that mean for us in terms of tax? So we have to draw a common parallels, and we have to take positions. In a transfer pricing world, positions are really important. Positions means how are you disclosing your related parties, connected persons, if there are certain gray areas. And positions come across what we have seen in other countries, which have had transfer pricing rules for quite a long time now, such as Saudi Arabia, Egypt, Morocco, Qatar, etc., and also the Western countries and our motherland, India, which has very complicated transfer pricing rules and super complicated tax authorities. So just to sum it up, in terms of directors, if we have to draw a reference as to what directors or officers could mean for transfer pricing, it could basically be chairman, board of directors under the definition of directors and related parties of them through the fourth degree of kinship. Or in terms of officers, we are basically looking at the C-levels, the CEOs, the CTOs, the board of directors, general managers on the trade license. If there are not C-levels in the organization, then people similar to the C-level roles in the organization. Sometimes we also see general managers on the trade license, directors on the trade licenses or charters of the companies, those who have been designated to be directors when the company was incorporated, or people who have been given a power of attorney to take certain decisions on behalf of the owners. So all these could basically fall in the category of directors or officers. But still, transfer pricing, the best thing in transfer pricing is nothing is right or wrong. You have to take positions, you have to prepare transfer pricing documentations, and it should be such that once a question comes in from the tax authorities, that documentation and your confidence and comfort level should be so robust that you can defend your argument in terms of the tax authorities, and the burden of proof is on them to prove that why they think that what you have done is not right. So all this will help you to fly through your corporate tax return in terms of transfer pricing with the FTA. Now, what does it take to disclose for connected persons in terms of the corporate tax return? We need to ask ourselves certain questions when we are dealing with the organizations for connected person disclosures. And they basically means, did they have any transactions with connected persons during the year? Now, in the prior slide, we discussed that have you identified your connected persons, so as to say the owners, directors, and officers, and thereafter, did you have any transactions with them in FY24? Did the value of those transactions exceed 500,000 dirhams for each of the connected persons aggregated with their related parties? If the answer is yes, disclose their name, TRN. TRN is a tax registration number or a tax identification number. It's not a mandatory field, it's an optional field. And TRN is basically for those natural persons, individuals who have obtained a CT registration certificate, who are doing a certain business activity that is also subject to a certain threshold. Now, after that, you have to define what are the payments or benefits which have been made to the connected persons, and what is the market value of that payment or benefit. So these are the key things which go in the connected person schedule in the corporate tax return. Now, still every day there are new approaches coming in as to how we benchmark. How can we benchmark someone, like Sir said, he was the first PhD, being a first UAE national obtaining a PhD. If he might be running a professional organization, a business organization, how do you come up with, how do you remunerate his efforts, his contributions to the company, and where the company is today? It's not a straightforward exercise. There are a lot of pros and cons, ifs and buts, but again, the first step to do is to take one. We have to start from somewhere. So that is what we are trying to achieve. Before even thinking about how to benchmark, we need to understand the journey of the particular connected person, where the person came from, educational qualification, academics, roles and responsibilities in the company, the track record of the organization which the connected person, he or she has built in his career. How are the numbers looking like in terms of the organizations? What key decisions has he taken? Who is his or her reporting lines? Who is he reporting to or she reporting to? We have to do a functional analysis in terms of transfer pricing to understand the roles and responsibilities. And this is super important because what we have seen in other countries is that once the audits are materialized for taxpayers, the tax authorities are doing field inspections. We have seen this in KSA for several audits which we have dealt in the past, that they have done field inspections to ensure that whatever was submitted to them for review, whether that's actually happening on the ground or not. So it's very important to document the roles and responsibilities, the meeting minutes, the board of directors meeting, whatever is happening, to document them and to put that in your report when you are talking about the connected person remuneration. Now, what is the next thing? The next thing is benchmark. How do we benchmark? Now, a lot of times we come across, yes, there is some guidance in the commercial companies law, which mainly applies to the mainland companies. And it says that if the company is in profit, then the board of directors remuneration could be 10% of the total profits, or if the company is incurring losses, it could be 200,000 dirhams per connected person or per the director. But again, commercial companies law is not directly dependent or not directly relying on the CT law and vice versa. So we cannot completely draw an analogy there. It's a directional outcome. So we have to see what approaches we follow. One of the good approaches could be, does the company has a strong HR policy, which is having a basis of how it remunerates its connected persons, etc. Then we could use internal references. Apart from the HR policy, whether companies have some strong database documentation as to how the remuneration is being given to connected persons, owners, directors, officers. We could also use certain transfer pricing databases, but the problem is that in this part of the world, data is limited because there was no need for companies to publish financial statements. So if we take data of individuals who are sitting in Western countries, then the economic conditions don't match. Then the purchase power parity adjustments have to be done. One of the other ways to do is to go to an HR firm. Like we have a set of HR firms, Cooper Fitch, Michael Page, Robert Half Hayes. They have been in the Middle East for quite some time. They are on the FTA portal for a list of approved hiring for the federal tax authorities and the Ministry of Finance. You could use their databases. So there are several ways you can benchmark a connected person remuneration. Now it has to be seen on a case-by-case basis what works the best for you and your organization in terms of disclosing the connected person information and benchmarking the market value of their payments. Now, what are the key pain points we hear every day from our clients, our friends, our businesses in terms of the transfer pricing disclosure forms? The first thing comes across the tax groups. What thresholds have to be seen if a taxpayer is forming a corporate tax group in the UAE? So how do we assess that threshold? In that case, basically, we see that what is the value of transactions undertaken by the entire tax group with entities or individuals outside the tax group. That threshold is considered. However, if a certain member of the tax group breaches certain conditions, like it has pre-grouping interest expenditure, losses, claiming a corporate tax advantage, claiming a free zone holidays, those type of companies in the tax group need to be separately complying with transfer pricing rules. But generally, in a tax group, if you have to see the thresholds, it has to come from the transactions the tax group undertakes with companies or individuals outside the tax group, be it domestically or internationally. The second key thing which comes to us around the pain points is there are 7 transaction categories: goods, services, assets, liabilities, IP interest, and others. Whereas if you see in Saudi Arabia, there are just 4 categories: tangible, intangible, financial transaction, services. Now, in which category to report certain transactions? Goods, services is easy. So IP is easy, interest is easy. What do you report in assets, liabilities, and others category? So a call on that has to be taken very cautiously on a case-by-case basis. So on which category you report your transaction particularly around. Now, the next pain point comes around intercompany loans. So one related party or a shareholder has given loan to its own company, its related party in the UAE, outside the UAE, whether the loan principal amount has to be considered in the 40 million and the 4 million threshold in the UAE. Yes, positions can be taken, and at least our position is that we do consider loans in the 40 million category and also the 4 million category, and we do disclose loan amounts. And generally, the expectation is that in the transfer pricing disclosures, only those items should go in which impact the taxable income of the taxpayer in FY24. However, since there are so many gray areas, it's better to be safe rather than sorry. Over-disclosure is better than not disclosing or under-disclosing. So we are taking safe positions, kind of disclosing these kind of transactions of loan principal amounts and even interest on loans, definitely, if the loans are carrying an arm's length interest rate. Now, people do get confused sometime. There are so many thresholds. So the thresholds are 40 million, 4 million for transfer pricing related party disclosures, 500,000 dirhams for connected person disclosures, and then there is a separate thing going on for local files and master files for which the threshold is 200 million, which we'll discuss in a moment. It's very, very important that we understand these thresholds properly. We understand what needs to be reported when and where, and we only report what's required, because less is more. The tax law is new, it's evolving. Just last week, we had a new decision on qualifying free zone persons, expanding the qualifying activity list to certain more corporates. So we have to take it step by step, and it's very important to understand the disclosures properly. Then transfer pricing adjustments. What happens if you miss putting the arm's length markups or profit margins on the transactions in your returns or in your financial statements? What happens in there? Then you can do a transfer pricing adjustment in the return. You can voluntarily offer your income to tax. You can inflate your income and let the FTA collect taxes on it. Downward adjustments are possible, like if you're reducing your taxable income, but it needs a special approval from the FTA. And in many other countries, in case of downward adjustments, we have seen the tax authorities raising eyebrows, because if you are doing downward adjustments with huge outbound payments on service fee, royalties, etc., they do question sometimes. So we have to be very careful what adjustments we are processing in our transfer pricing disclosures in the CTA return. Equity capital contributions. We do see some cases wherein the shareholder is putting some money in the business, either through equity or through debt. Sometimes the authorized share capital and issued share capital are maxed out. Then money is being inserted through current accounts. So even these kind of situations have to be assessed on a case-by-case basis and have to be thought, okay, it has a taxable impact or not. But what's the safest position to do? Is it good to disclose, not to disclose? And then have your BOP documents ready, as Nirav sir was saying in the morning, describing TaxMate. BOP, basis of preparation, is super important when you're filing your tax returns, your transfer pricing returns, because it gives you an idea of what were you thinking when you were filing your tax or transfer pricing returns. So BOPs are super important now. There are some transactions which are going free of charge. No interest rate is applied on the intercompany loans. Cost-to-cost transactions are undertaken where they should have been marked up with a certain profit markup. They have to be seen. Reimbursement of expenses, very common in the UAE. One entity paying on behalf of the other entity. Yes, they need to be reported in the transfer pricing disclosure forms. And connected person market value determination. In the connected persons, you have to disclose the gross value and the market value. This could trigger an upward adjustment. So it's very important that we are aware what is the market value of connected person payments or benefits when we are disclosing them in the return. Now, coming in to the next phase of transfer pricing documentation. Now, this is called a master file. It's a technical term, but basically what it means is that if you are a multinational organization, if you are operating in more than one countries, and if you breach a certain threshold, which we will discuss on the next slide, it's 200 million. If you breach a threshold of 200 million dirhams in FY24, or you are part of an M&E group whose consolidated revenue in FY24 exceeds 3.15 billion dirhams, then you are required to prepare a master file. There's no requirement to submit it. It is required to be prepared. Now, what does that mean? What is a master file? A master file is a document which gives a high-level blueprint of your business at a global level to the tax authorities. Imagine tax authorities in the UAE sitting at 60,000 feet. They want to understand what your business looks like at a global level and the UAE level. Yeah. So it has 5 different reporting items. The first is the organizational structure. That means that in the master file, if you breach the threshold of 200 million or 3.15 billion dirhams, you have to describe your legal structure in the master file and the geographical locations of all your group entities. That is the first reporting item. The second is business description of the group. You have to define the business activities which the group is undertaking on a global level. Now, it will also include what are your supply chains, business end-to-end, value chains, more for technology companies, AI-driven companies. What are your top 5 products or services which exceed more than 5% of the turnover? Those have to be defined. What is the functional analysis? That in simple terms means what are various geographical entities doing or contributing in terms of the businesses. Someone are manufacturers, someone are distributors, someone are lenders, someone is a treasury center, service providers. It has to describe all that. Then if you have done any business restructuring, any acquisition or divestiture in a particular year, have you acquired someone, you have been acquired by someone, have you broken down your business? And have you obtained any tax rulings, the advanced pricing agreements, etc., with the tax authorities to get certainty on your tax arrangements? That has to go in the business descriptions. Now, the other category which we need to report in a master file is intangibles. We have seen the businesses leveraging several types of intangibles such as brand, trademark, trade name, patents, copyrights, etc., software patented, unpatented technologies. All these intangibles have to be reported. How are these intangibles leveraged within the group entities? Are you licensing them out? Against what remuneration? Do you have intercompany agreements for those licensing arrangements? What are the policies? All that has to go in the intangible section. Then comes the financial activities. So how the group is leveraged, what kind of funding the group has undertaken. Is there an internal treasury center? Is there a cash pool? Are you taking funding from third-party banks? That has to go in the intercompany financial activities in there. And what's the policy for funding? Have you applied interest rates? Have you applied interest rates, debit, credit rates in the cash pool? What was your basis of arriving at those interest rates? That has to be disclosed in a master file. And then the last thing is financial and tax positions, which basically means how do your consolidated financial statements look like? Have you taken any tax positions? So describe that in the form. And this is how a master file looks like. So the whole objective of the master file is, if we go back to 2013, when base erosion and profit shifting project was announced by the OECD, now it has been implemented by more than 100 countries. The whole reason for bringing in a master file was transparency, coherence, consistent reporting across the jurisdictions, for risk assessment by the tax authorities, and common reporting standards. So that is why the master file was brought into play. Now, the thresholds we have already discussed. that you have to have a threshold of 3.15 billion dirhams at a group level or 200 million dirhams at a UAE entity level to be eligible to prepare a master file. Ideally, a master file has to be prepared. It doesn't need to be submitted, but it needs to be submitted within 30 days upon request of the FTA. So the window is really tight. So it's really important that we do prepare and maintain our master files, because these kind of things stemming out of the master file will be somehow required in preparing your local file, which we'll discuss after this, and also filing your CT returns in the transfer pricing section specifically. If you don't meet this threshold, it doesn't mean that you don't have to do anything. You still have to make certain transfer pricing documentations to prove to the tax authorities that you have done an analysis to meet the arm's length principle under the law. It doesn't mean that if you don't meet this threshold, you have to do nothing. You still have to prepare certain set of documentations. Now, what we are seeing in the UAE, mostly for foreign headquartered groups, is that we have a master file. Say a group is headquartered in Denmark and it's operating in 10 plus countries. There is a requirement to prepare a master file in those countries, but the UAE is very often excused from having its place in the master file. So what does that mean? If we review the master files coming in from abroad, we don't see the UAE legal structure or the UAE entities in the organizational structure. In the description of the group's business, UAE entities are not defined well enough. In the intangible section, we don't see how are the UAE entities owning or exploiting the intangibles. In the financial activities, we don't see that what kind of loans are flowing in between the UAE entities, either externally or internally. And even in terms of financial positions on the financial statements, UAE is not well disclosed enough. And to be honest, there was no need before because the law was not existent. But now when we see master files for foreign headquartered groups to be used in the UAE, whether they will hold good in terms of the FTA, we might need to make some changes to ensure that the UAE storyline is appropriately captured in those master files. So we kind of do a fit gap analysis to see a foreign headquartered group submitting its master file when requested by the FTA, whether that will hold good or not. Now, before we go to the local file, I would just like to take some key questions which come to us when we are preparing master files. And these are 3 or 4 key questions as to who has the responsibility to prepare master file in a group. Generally, it's the headquarter, because these are group level documents and the HQ should maintain them. However, in the past, several countries belonging to UAE headquartered groups who had requirements in local countries, either to prepare or submit a master file, they did it on their own behalf. But going forward, centralization is happening in terms of finances and taxes, even for UAE headquartered groups. So a master file is generally prepared at the group level. Now, the second question comes in, do I really need to provide consolidated financial statements in the master file? The answer is yes, you have to. It's a mandatory requirement. You have to provide that in a master file. The third question comes in is how soon a master file should be updated. These kind of reports should be updated on an yearly basis. Because it's a year-on-year exercise, and every year how your business is operating, what changes it's undergoing, all these have to be described in the master file. And the last and final question is, what is the difference between a master file and a local file, and which is when we go to discuss the local file now. So similar to a master file, there is another level of documentation in transfer pricing, which is called the local file. What the local file essentially means is that the tax authorities, they want to know all the information about the UAE taxpayer, like what are the business operations, legal structure, people structure, what related party, connected person transactions are undertaken by the local UAE company, and what is its financial and tax position. If we talk about the UAE transfer pricing rules for transfer pricing local file. Threshold is the same as master file. So if your revenue exceeds 200 million dirhams, or if you're part of an M&E group, with revenue exceeding 3.15 billion dirhams, you have to prepare a local file. Now, master file, there is one exception that if you're not multinational, you don't have to prepare. But for the local file, you have to prepare for each set of UAE taxpayers whose revenue exceeds 200 million dirhams or the group-wide revenue exceeds 3.15 billion dirhams. Similar to a master file, a local file needs to be maintained and submitted once the tax authorities are asking for it. Again, a very small window, 30 days only to submit a local file once asked. Now, we do get asked certain questions on the local file, but just before we go there, I would like to spend a very quick moment on what a local file should contain. So as I said, local entity business overview, strategy, what is the strategy for exploiting the market, for churning out revenues, hiring people, what are the transactions you are undertaking with your related parties, connected persons, their values, what are the roles and responsibilities of the related parties and connected persons in those transactions, how do you benchmark it, what method you choose to determine the market price, and whether you have obtained certain tax rulings or not with the tax authorities in terms of the transactions which the UAE local taxpayer is involved in, or in the transactions which are coming in from a foreign country, from a foreign related party, whether there are any tax rulings which the foreign related party has taken in terms of the transactions which the UAE entity is undertaking. There are certain inclusions and exclusions. I'll not go into the details, but it's just thinking out loud that if there is a tax arbitrage, like 0% to 9%, 0% to 0%, 0 to 9, 9 to 0, if there is a tax arbitrage, the transactions need to be reported. If not, then the transactions are excluded. Connected person transactions are specifically written to be excluded, subject to the conditions that connected persons and the companies are acting independently of each other. Now that is again a transfer pricing phenomena to prove that they are acting independently of each other. And how do you prove that is via transfer pricing exercise. Now, we do get a lot of questions on the local file, and we have just pointed out some famous questions which we get every day. One is that local file threshold. Many a times we are asked that if we don't meet the threshold, we don't do anything. There is no need to do transfer pricing. That's not right. That's inappropriate. If you don't meet the threshold of 200 million or 3.15 billion, it doesn't excuse you from ignoring the arm's length principle embedded in the transfer pricing law. You still have to do it. The second question which comes in, if we don't breach the threshold of 40 million, 4 million, 500,000 in the disclosure form, but breach the threshold of 200 million, 3.15 billion for the local file, do we have to do it? Yes, you still have to do a local file, even if you don't breach the threshold of TP disclosure forms. Free zones. Is there a requirement to submit transfer pricing documentations, local file, master file for a free zone company? No, it's not. You just have to prepare and maintain and submit upon request. The window is small, so be prepared. Don't do it at the last minute. And these are kind of very important documents which summarize your conclusions in the TP return. So it's always good to have them handy before you file the return, unless there have been certain situations where we came across a transfer pricing adjustment, but then we realized, okay, let's prepare the local file first, put the adjustment in the local file, and then file the TP disclosure form in the CT return. So it's important to be filed before. Now, again, the adjustment point came in. If you are making some adjustments to your taxable income in the TP return, whether you have to put them in the local file, yes, we have to put those adjustments in the local file. The whole idea of BEPS 1.0, 2.0, the international tax rules and the UAE tax rules is transparency, consistency, and coherence. So all the documents in their respective terms should speak the same language and give a consistent storyline to the federal tax authorities. Tax groups. Can a tax group prepare one local file? Yes, if there is a tax group which is breaching the threshold, it can have a local file for the transactions outside the tax group, domestically, internationally, with individuals or natural persons. Now, if the single entity within a tax group exceeds the threshold for preparing a local file and the others don't, then is a tax group required to prepare a local file? Yes, because the tax group as a whole is seen and that entity also forms part of the tax group. So if that's the case, you still have to prepare a local file and submit upon request. Do branches need to prepare? Yes, branches, if they qualify thresholds, need to prepare local files. We have seen situations of mainland entities with with domestic branches claiming a QFZP holiday. In these cases, two kind of local files need to be prepared, one for the mainland entity and one for the branch, because from a transfer pricing perspective, branch is hypothesized as a separate legal entity. Now, economic analysis. Now, this is a very important one. People say our entity is taking 10 transactions. Do we benchmark entity by transaction or entity-wide? Do we just benchmark the entity? Again, the preference of the UAE FTA in the transfer pricing guide is that you look at each respective transaction and benchmark it. However, if there are simpler entities which are engaged in routine transactions, you could also look at entity-wide benchmarking, though not preferred. In this, a very famous situation came in some time back that we did benchmark transaction by transaction, but in the end, entity was incurring losses. So we did have to collaborate with an aggregation entity-wide analysis as well. Now, there are 6 TP methods. Any order of preference? No, there's no order of preference. It was back in before 2010 that there was a certain order of preference for certain methods. Now, no more. You can choose any method. Does the local file need to cover transactions with connected persons? No, to the extent we can prove that they are acting independently of each other. But to prove that, certain level of documentation is required. And then a full-fledged analysis is required to determine the market value of the transactions. Benchmarking analysis, again, are there some specific nuances to be kept in mind? Yes. The preference is to use local comparables, but the situation is that we don't get a lot of local comparables, UAE, MENA-based. Market is still developing, evolving. So we have to go maybe to Eastern Europe, Western Europe, Asia, etc. Sometimes we do get comparable companies which have extreme results. Do they need to be included or excluded while computing the arm's length range? Ideally, you should include them. Don't exclude them just only because they are earning high margins. Do an analysis of a weighted average 3-year period to see why the high margins are stemming from and where is it coming from, just to take a decision. What is the frequency of conducting benchmarks? You have to conduct a fresh benchmark once in every 3 years, and a financial update has to be done every year to update the financials of comparable companies and you as a tested party, you as an organization as well. Is industry overview important? In the UAE, it's not required. But in Saudi Arabia, SWOT analysis, 5-factor analysis is really important to be mentioned in the local file. So these are some things which came across in the local file. Now, we are in the UAE. A lot of things are going in the UAE. The tax law is brand new. It's evolving, developing. Everyone is learning. We are learning every day. Now, what's happening across the Middle East? When we look at Saudi Arabia, Egypt, Qatar, even Jordan, Morocco, Oman, Kuwait, what are the tax authorities looking for when it comes to transfer pricing? There are 3 main things which we feel are super important to be understood. One is benchmarks. Like Egypt and Saudi Arabia, they have a preference, such as the UAE, for local benchmarks, local comparables, or Eastern European. Like Saudi Arabia specifically excludes loss makers. They don't want loss makers in the benchmark set to be compared to the businesses. That has to be seen. Transfer pricing returns. The returns are specific per country. UAE has a transfer pricing return. Saudi Arabia has a transfer pricing return. Even an affidavit, when a third party has to disclose that the information which we are presenting in the tax return, is it accurate or correct or not? And it gets super serious because someone is authorizing disclosing it, just like we have in India. Then Qatar also we have a TP return. So TP returns are super important, strategic document to be filed. Then filing of transfer pricing documentations. In the UAE, you have to maintain local file, master file, give it upon request. So is in Saudi Arabia. But in Egypt, you have to file it. In Qatar, you have to upload it on the Riba portal. So these three key things are really topping the charts when it comes across what tax authorities are looking into in the Middle East in terms of transfer pricing. And what have been the most recent developments? We have seen that the UAE has announced that it will be bringing in advanced pricing agreements, APAs, which gives certainty on transfer pricing positions of a taxpayer for a set of years. So that will be coming in. In that, you can have an arrangement with one tax authorities on your related party transactions. They can bless it for a period of 3 to 5 years. Even in certain countries, they can bless the past year's transactions as well. There is an RHQ regime coming in Saudi Arabia for regional headquarters from 1st January 24 together with APAs. Now, APAs have a threshold. So if the value of your transactions in Saudi Arabia exceed $25 million and those transactions are complicated, then you have to do APAs. And in terms of the RHQs, if you are dealing with the Saudi government, local contracts, you have to establish an RHQ there in Saudi Arabia. It has to provide management, head office services, cannot do commercial business activities. So in APAs, RHQs, it's really, really important that transfer pricing is maintained. Pillar 2 is coming in. UAE has already alluded to Pillar 2 from 1st January 25 onwards, 15% tax rates for businesses whose revenue exceeds 3.15 billion in the last 2 out of 4 years. In that, transfer pricing plays a big role because year-end transfer pricing adjustments, compliance burden, your ETR rates, that is all impacted by transfer pricing, and it will interplay with Pillar 2 quite well. So we have to be cautious about Pillar 2 even in terms of transitional safe harbor rules for country-by-country reporting, which existed in the UAE since 2018. So Pillar 2 also is a recent development to be followed in terms of transfer pricing. And then free zones and special economic zones. Free zones in the UAE, SEZs in Saudi Arabia. If you have to claim a 0% tax holiday, you have to ensure that your transfer pricing is very, very tight. You cannot excuse or ignore transfer pricing to the slightest of thread when you are claiming a free zone holiday in the UAE. It could be taken away for a set of 5 years. And now, when we have negotiated audits with, specifically mostly with Saudi tax authorities, ZATCA, with Egyptian, Qatari, Moroccan tax authorities, what are they looking at? What are the key audit triggers they look at in the taxpayers? The first one is operating losses. If the local UAE, KSA, Egyptian, Qatari company, if they are incurring losses, they are reporting losses, not paying taxes, corporate income taxes, and they are making huge outbound payments on services, royalty fees, etc., they come under the scanner of an audit. They are on top of the charts for the audit. The second is downward TP adjustments. You are earning 10% margin, but you do TP adjustment wherein you come to 3%, 5%, and you have huge outbound payments, then again, that has to be looked at from a wider angle. The tax authorities have that eye on you. The third thing is insufficient transfer pricing documentation. So if you don't have sufficient level of transfer pricing documentation which can convince the tax authorities that whatever you have done is compliant with the law, you could land up in an audit. And permanent establishments, people flying in and out of the countries and having a taxable presence in a particular foreign country, but the revenue is booked by, say, for example, UAE. I'm traveling from UAE to Saudi Arabia for doing business. I'm doing key business activities, but the revenue of Saudi is booked in UAE. Then you could have a problem from a tax authority perspective. Now, what have we seen specifically in the case of the Saudi tax authorities when it comes to transfer pricing? They do request information from other tax authorities under exchange programs. They are disregarding benchmarking analysis fully or partially. they are also connecting transfer pricing to the other rules like VAT, permanent establishment, withholding taxes, and they do request a lot of information specifically for the entities which are incurring operating losses, etc. There are a couple of case studies wherein the Saudi tax authorities did initiate an audit, although we were quite successful in getting a favorable outcome. So like in this case, I'll just take a couple of minutes more to just take you through two case studies. So there was an overseas company 1 and 2, and there was a KSA service provider. Company 1 was in a tax haven, company 2 was in a low tax jurisdiction. Then there was a service provider who was getting some equipment and some services. That KSA service provider, the first 3 boxes are related parties, and the last 2 are third parties. So the KSA entity was providing some services to third parties. The KSA entity was consistently incurring losses, and Saudi tax authorities challenged, why is it consistently incurring losses? We will audit it. But then we were able to prove with sufficient documentation that the losses are not stemming from transfer pricing, they're stemming from other things, commercial business reasons. So there is no need to do a transfer pricing adjustments, and the losses are feasible from a transfer pricing perspective. Then there was another case where we had a KSA operating company with a related party, which was providing management services to its group entity, and the KSA entity was paying a management service charge with withholding taxes being deducted. Again, the tax authorities in Saudi Arabia contested this, and they say that related party service provider didn't have any people, so why management fees are being paid over there in huge quantities? Again, through sufficient documentation and paperwork, we were able to come up with the sufficient documentation, which helped us prove that no, it's not the case. There are people out there, so documentation is really important when you're dealing with these tax authorities. Now, just on the last 10-15 seconds, what do we want to leave you with today? In terms of the action items, understand your related party connected person transactions, understand the roles and responsibilities of parties, the transactions, how you are pricing them, see that an appropriate transfer pricing method is selected to be benchmarked to determine an arm's length price for each category of transaction, appropriately disclose them in the corporate tax return under the transfer pricing rules. Be comprehensive, be conservative. More disclosing is better than less. Then, at the safer side, please follow certain developments which are about to come. In Q4, the FTA has promised that they will give more information on advanced pricing agreements, follow Pillar 2 rules, mutual agreement procedure also. When there is contesting, 2 tax authorities are contesting a TP adjustment, you can get into a mutual agreement procedure to finalize the battle against the 2 countries in terms of who should get what level of taxes. So there are a lot of developments coming in, and the free zones definitely have to be taken care of from a future perspective as well. And the biggest development coming in against Pillar 2 and e-invoicing is worth to watch. Thank you so much all for listening in. Really appreciate. Thank you.
Thank you so much, Rishi Bhai, for such an insightful and the practical sessions. I would say it was equally sharp as your tie color as well. So thank you so much, and I would like to request our chairman, vice chairman on the stage, and along with our one of senior members, CA Maheshji Prabhu on the stage. Maheshji Prabhu to come on the stage to please present a memento on behalf of the chapter and the managing committee. I cannot see the Rishi Bhai, so in that case I call CA Ashna also. Please come on the stage. Thank you so much, Chairman, CA Jaiprakash, Maheshji Prabhu, Rishi Bhai once again, and our very own Treasurer, CA Ashna. So, moving on. Members, that was CA Rishi Sapra from the Young Global, but the story of the transfer pricing is not over yet. Continuing our focus on the transfer pricing, the session looks at the UAE transfer pricing, understanding the intricacies and the latest UAE tax development. So expect practical clarity on the documentation readiness, risk areas in the intercompany pricing, and how evolving guidance affects your financial year 2025 compliance posture. So to formally introduce our next speaker, CA Arun Saripalli, may I invite our very energetic and bright Executive Committee member, CA Balram Buchudi, on the stage. Can I have a thunderous round of applause for CA Balram? Thank you.
Thank you, Amit. Good morning, ladies and gentlemen. I would like to quote our chairman's statement that if you really are interested in learning, you don't mind in traveling to any place. So glad to see so many of you traveling from many other places of our city to this college with an interest of purely learning. It is my honor to introduce our next speaker, CA Arun Saripalli, who is a partner with PwC Dubai. He is a TP advisor over 2 decades in tax and regulatory matters. Arun brings a deep expertise in advising both inbound and outbound clients, supporting them with cross-border structuring, business models, evaluations, IP structuring, and negotiation of advanced pricing agreements, which is going to be the next big thing. He advises on documentation compliances and providing litigation support at various levels, including in tax courts. In addition, Arun also authored and co-authored several publications and is a regular speaker at various events and professional forums. He also contributed in revising ICAI guidance note on transfer pricing and also building the diploma course material on international taxation with ICAI. So when I asked him, what do you want me to mention about you? He modestly said that you tell that I only know a speck of the transfer pricing. So that is the kind of modesty he has shown. So with his vast experience and commitment to share the knowledge, he has been established as one of the trusted advisor and a voice on international tax matters. So without further delay, I would like to request you all to join me in welcoming CA Arun Saripalli onto the stage.
Morning members, it's an honor. So thank you ICAI committee and the honorable members for giving me this opportunity, and thank you to each of you to spare time on a Saturday to come all the way and to listen to this topic of transfer pricing. This moment is special for me for 2 reasons. As you know that I have been with ICAI for a long time. It's like my home for me now. And there is a special reason because Pramod sir, who's sitting out there, I was standing at, in some of the Mumbai tribunals representing a few cases before him. So it's an honor to, sir, again speak before you. Thank you. So before I start, can I ask, how's the Josh? Sorry? I can't hear. See, guys, this is the first compliance season that we are doing. And first is very important for everyone. The first man on the moon, the first day in the school, the first date, and the first marriage. We all remember that, yeah. Now that's the Josh. So, first TP compliance. And we are just round the corner around this. So 17 days left for us. But before we get deep dive into some of the technical aspects that I will be talking about, because Rishi covered a lot on the transfer pricing, the needs and requirements, so I will be talking only on some of the technical aspects. I also urge you to talk and ask questions on what are the technicalities you are facing and technical positions that you want to take, and I'm more than happy to answer on that. If I just step back before I talk about technicals, think about this. This probably is like the mecca of taxes and mecca for the tax professions, the whole of Middle East. It's not moving. Can you hear? Can you just check? So the reason I say this is mecca is because if you see the whole of Middle East is been introducing taxes. So if you see the journey, starting with Saudi, introducing corporate tax and transfer pricing somewhere in 2019 and extending it to zakat payers as recently as last year, the whole region, whether it is Bahrain, Kuwait, Qatar, UAE, has been progressively introducing taxes. And they have been introducing variety of taxes, including, as I said, VAT. The e-invoicing is on the radar. We are talking about DMTT. I'll touch upon it in a minute. Rishi also spoke about it. So this is probably the best time for all of us as chartered accountants to be in this region, to learn and also give it back to the society of what is our learnings from various markets, because I'm sure many of you have an experience of being in the Indian market or wherever, and your experiences will count. So that's the kind of trajectory that we are seeing. So if I just think, oops, what happened? Sorry. So I'm not going into this because the requirements, Rishi spoke in detail about this, so I'm not touching upon this. But I'm going to talk about a few nitty-gritties and things that you need to be aware of. So Rishi talked about thresholds, the 40 million, etc. Okay. Interesting point in that threshold is, it says the threshold has to be computed as per financials or arm's length value, whichever is higher. What does it mean? So if you look at it, am I audible at the back, or you want me to be here? No? I'll speak here. Is it better? Okay. So when we talk about transaction values and arm's length value, okay, it is based on the financials. That's a starting point, but that's not the last point, because this has to be determined if the arm's length value is higher than book value or vice versa. That value has to be considered. Take an example, a free of cost transaction that is reported in the books or disclosed in one of the notes, and if I have to consider that for the threshold purpose, the value is 0. But does that stop me? Answer is no. The law requires us to determine the arm's length value. And if the arm's length value is exceeding those limits, the 40 million or 200 million, as the case may be, then we are required to determine the arm's length nature of this transaction and do the necessary disclosures. So that's one point to be kept in mind, because of late there have been queries that have been coming to me saying, oh, the transaction value is below this threshold. Why should I do anything? Determine the arm's length value also. The second point I just wanted to talk about is, there is a discrepancy in the related party schedules, because when you look at related party definition as per IFRS or the accounting standards that are there, and what is given in the transfer pricing, there is a difference. So think about this. Transfer pricing says related party has to be determined based on capital control or management or significant influence, and then we have a connected person. IFRS does not have the same yardsticks. They are probably more. So take an example like this. An associate who's holding 20% in a company is still a related party from financials perspective. But is an associate a related party for TP? Answer may be no or yes. Okay. So what is required from us as transfer pricing and tax professionals is, when we are doing our compliances, have a reconciliation done to say that, start with the financial statements as your starting point, look at those related parties, and then make a disclosure to say, or an assessment to say, whether the related parties as per financials are also related parties from a transfer pricing perspective. And there is an important point that I just want to highlight for all of you is, there is a term called significant influence. How many of us are aware of this term in the law? Term significant influence? I just see one hand going over, two hands. Thanks. So there is this term which is there in the law, but it is not defined. It says if two people or two parties are having significant influence on each other, they will be considered as related parties. But very unfortunately, the law does not give enough examples to establish conclusively to say what is the significant influence. Is a 50% shareholder or a 50% lender a related party because of significant influence? Answer is yes, maybe. Is someone who is supplying materials, who is a dominant supplier, because he can influence the pricing of those transactions, is he a supplier, is he a related party? Answer may be yes. So it's a subjective evaluation that has to be done. So before you file your first compliance, the advice that I wanted to leave you guys is, do a reconciliation of related parties with your financials, and do this, and please add an addendum in your notes when you're filing your return to say that related party as per financials and related party as per your transfer pricing. So that's another point I just want to leave you guys. The next point is, Rishi touched upon this to say arm's length value and if there is an adjustment required. So take an example. You're doing a transaction at cost plus 10%. The arm's length is, let's say, cost plus 12% or cost plus 8, which either cases. What do you have to do? What you have to do is you need to make an adjustment in the return and disclose it, because when you look at the form which is given out, it says transaction value as per the books, and then there is a column which says arm's length value. So you need to disclose this. This becomes very relevant when we are talking in the context of free zones. We are all aware of the free zones, right, over here, the 0% tax. The 0% tax is not automatic. One of the key conditions that you need to fulfill is that your transactions with related parties are undertaken on an arm's length basis. So take this example, you're doing a transaction at cost plus 8%. Your books are closed. Your transaction values have to be, benchmarked to be at arm's length. So what do? What you need to do is when you're filing your return, you need to make that adjustment and disclose that adjustment in the return. That's how you'll be able to, make a case that my transactions are still compliant from an arm's length perspective, and therefore I should be eligible for a free zone perspective, benefit. Because again, as I was talking and I started my conversation on this, first year is most important, more so in the case of free zones. Because if you miss free zones exemption in first year, you are going to miss it for next 4 years. So that's an important thing, especially when you're looking from a free zone perspective. Rishi touched upon downward adjustment. Now if you see what's happening today is, the law says if you have to make a downward adjustment, there is a process and procedure to be followed. But as we stand today, is the process codified? Answer is no. We don't have a law which says what is the downward adjustment, how the process has to be done, etc., etc. So what we need to do is, in the return, please make us voluntary downward adjustment. Because if you don't do it, you probably will miss the opportunity. So take this example. Again, your transaction is undertaken on cost plus 10. The arm's length value is cost plus 8. And the arm's length value is the right value. So what you do? When you file your return, make a downward adjustment, and you please add a note in the return to say that, look, when we are doing this, the process of downward adjustment is not yet prescribed. And that's why this is a bona fide claim that we are making, so that when you go to the tax authorities tomorrow, day after, when they prescribe the process and procedure, you have that ability to, argue before them. I think Rishi already touched upon this, the thresholds, the reporting thresholds. But again, one important point which he made, and I want to re-emphasize is, there are a couple of, interesting areas. The thresholds for disclosure form, the threshold for TP report and master file are different. The threshold for master file and TP report is 200 million or 3.14 billion AED. The threshold for your form, the disclosure form, is 40 million. Now why is this interesting is because you will have a scenario where the groups are not meeting the 43 million threshold, but your transactions still have to be compliant with arm's length. Your group is meeting or not meeting the 200 million or 3.14 million threshold, but your transactions are still crossing that 40. You still need to maintain documentation and also ensure that your compliance is done. So either ways, the summary is, if you have a related party transaction, more likely than not, you will have to comply with transfer pricing provisions. So that's a good news for all the consultants sitting in this room. So not sure for the taxpayers, but for tax consultants, it's a good news. Jokes apart, this also sets the precedent, because this year, whatever you do is the base. Again, I'm harping on it because next year, let's say this year the thresholds are not meeting, but suddenly you go to the next year when your thresholds are breached. What will you do? You will make adjustments to your transfer prices? No, you'll have to start from day one. So it's the best practice that if you have related party transactions, whether you're crossing the threshold or irrespective, please do an arm's length analysis. Balance sheet. Again, Rishi covered this point on whether transactions of balance sheet are covered, so I'm not touching it again on this. And I'm short on time on this. Important. People are missing this point is, if you read the guide says the related parties and related party transactions which have been made on not an arm's length basis have to be reported. What it means. And this is specifically very important and interesting from a UAE perspective, is what's happening is with the introduction of corporate tax laws, there have lots of restructuring that has happened. So people have moved their businesses from mainland into free zones and vice versa. And when that movement has happened, many of the cases it has so happened, or at least FTA believes that it is so happening, is that transactions are done on a non-arm's length basis. Take an example on this. You had a plant and machinery which was lying on the free zone. That plant and machinery got transferred into the free zone, from mainland into the free zone as part of this business restructuring, without payment of an adequate arm's length consideration. Now what happens? You are sitting in the free zone and you are now computing a profit or a benefit out of that free zone, the machinery, plant and whatever is the depreciation on this, which is not at right value because you never did the transaction at a right value. So in that case, FTA is clearly asking that in case you are making any transaction or a benefit or a gains from transactions of transfers done from a related party on a non-arm's length basis, please do disclosure. So this becomes a tricky part, that when you're talking to your clients or you're doing analysis yourself, that you take a minute back and analyze that if there has been a transfer or a transaction between mainland and free zone or cross-border, either ways, whether the transaction is compliant from a transfer pricing perspective. If not, there is an possibility that FTA will come back to you and they will make an adjustment on this. So that's the other point I wanted to cover. Connected transaction persons, I'll talk in detail a bit more in a minute. Free zone TP documentation, I think Rishi has already touched, so nothing more to talk on that. Okay. Connected persons, probably this is where I want to spend a bit more time, is because this is a very new concept. Because unlike transfer pricing, if you go to transfer pricing and you see around, you'll get lots of guidance from local as well as global markets. Connected person, unfortunately, is one of those areas which is very peculiar to this region. But before I just go into this connected persons, have we really thought why connected person was really introduced in this place? The rationale of introduction is because what's happening in this place is the individuals are exempt from taxes. So it's a planning idea that can be used by companies to say, instead of paying $1 million salary, I'll pay, let's say, $10 million. Company gets a deduction. The owner or the connected person gets an income which is tax-free in his hands. So to at least curb this practice or to ensure that transactions are done, they introduce this, and the law is beautifully worded, because the law says the payments made to connected persons will not be allowed as a deduction if they are not at arm's length. It is not saying that payment made to connected person have to be at arm's length. The law says, I will not give you a deduction if the payments are not at arm's length. That's the difference. Now what it means is, whenever the payments are made, again using all the techniques that Rishi talked a few minutes back, you need to establish that the payment to connected persons are at arm's length for you to claim a deduction. Again, a classic case of interlap between transfer pricing and corporate tax, because unless we certify that this is transaction at arm's length, you cannot file your right return. So it's the interplay. Again, the second part is connected persons. We talked about definition, we heard about the definition a minute back. Connected persons are also related parties, or in most of the cases, they can be a related party. Take an example. We are talking about a case where owner who holds more than 50% of the shares in the company, is he a connected person or is he a related party? The answer is probably he is both. Now why is this really relevant in this case? We are only bothered about that $500,000 or 500,000 dirhams payment. But think about this, if there is a transaction of gift of assets, okay? So there is gift of shares by the company to the connected person free of cost. It does not fall under the category of that 500,000 that we are really talking about, which is from a, which is deductibility from a connected person case. Should we report it or should we not report it? The answer is we should, but not report it in the connected party schedule. And that's what I was talking a minute back, saying payments to connected persons are considered from a deductibility perspective to be tested from an arm's length side. But all transactions with connected person, even if they are not tax deductible, they still have to be at arm's length from a related party stand. And that's the interplay that you guys have to think about to say connected person versus related party, what is the difference? Because, and this again coming from the practical cases that we are seeing, that companies come back and say, we have not made any payment to connected persons. Why are we even complying with this? Sorry, you have to comply because the case that I was talking about, you gave an asset or a villa or a car or whatever it is free of cost to these guys. How does it matter? Or why it should not matter? And the other part that I just want to leave you guys is, it's not only payments made in cash that they are talking about. The payments or the benefits are being talked about. Very, very practical example. Owners of this company who own like luxury watch brands, I can't say the names, but you know, the luxury car brands, okay, let me use Majid Al Futtaims, etc., who are the owners. When the family members walk into the stores, they pick up a luxury watch. How much do they pay? Zero, sometimes. So what is that? That's a benefit. So it is, that benefit will not be reflected in the P&L anywhere as a payment to connected person. But the law obligates the taxpayers and the tax consultants alike to analyze this transaction, consider that in the overall limit, which is the payment made to connected person, and then do an appropriate disclosure or whatever that we are talking about. So please go look beyond financials to say that it is just not enough to say that, you know, payments which are made and debited in the financials are the ones that we look at and nothing further. It's much more and beyond. So that's on the connected person I wanted to talk about. Another interesting scenarios that we are seeing in the market is connected persons of entity A but paid by another group entity which is B or C or D. Now, the queries that have come up on this to say that, you know, we are not making a payment to connected person. What do? Do we report it as a connected person transaction or we don't report it as a connected person transaction? Again, the point over here is, if you see, there are two aspects that you need to analyze over here is that if in substance, entity A is bearing the cost of these guys either through a recharge or otherwise, and on paper it's a structure which is done that B pays this, you know, payment to connected persons, then you have to see substance over form. Because the law that we are talking today is substance over form. And go back to the point that Rishi was talking about. Over-analysis is good. Over-disclosure may not be, but over-analysis is at least good, at least in the first year. This sets the precedent. So whenever you are coming across these type of cases where there is payment made to connected persons of entity A by B or C or D, look at, you know, how the transactions are structured, because ultimately it may happen that through a cross charge, entity A is actually bearing all these costs. So just keep that in mind. The last one, free of cost transactions with connected person. Again, very interesting over here. If we just go back to the definition that we are talking about, that free of cost transactions, let's say a gift that has been given or connected person is providing a services to me and we are not paying any payment. Does it really matter? Is it really required that we just think about to say, I have not paid anything to the connected person has not paid me anything, how does it really matter? But this scenario has to be analyzed from 3 or 4 perspectives. Perspective number 1, if you are in a free zone, the requirement of free zone entity is that all transactions with related parties, including connected persons, have to be at arm's length, which means there has to be an arm's length payment that has to be given out. The second scenario, we talked about this example of owner's wife coming and picking up a gift or a watch from the store and not paying anything. The law says payments or benefits provided to connected persons. So this has to be quantified and considered and tested from an arm's length perspective, required under law. So that's mostly on connected person, but maybe I'll pause here. Any questions that you have on connected person or any different queries that you may be facing, more than happy to answer. Or I move on to my next one. The second thing that I just wanted to talk about is business restructurings. Again, this is relevant in the first year because lots of restructurings are happening in this year, have happened in 23 as well, before the corporate tax law came into picture. What is business restructuring? If you think about it, business restructuring, people will normally say it's amalgamations, demergers, share transfers, change of ownerships, are all of this restructurings? Answer is yes. But there is a very specific definition given in the transfer pricing rules which provides what is restructuring. And what it says is that any cross-border redeployment of resources such that there is a transfer of profit potential. So, very interesting words, cross-border redeployment of FA&R, functions, resources, assets, and transfer of profit potential. Now, is this only a cross-border that we are concerned with when we are looking at it from a UAE perspective? Answer is no. It equally applies to domestic transactions. Because if you read the law says that if this is happening between 9 to 9% entity, it's still covered. 9 to 0%, which is like mainland to free zone, it is still covered. Cross-border, of course, it's covered. So the question for us to think about is, what exactly is this restructuring that we are really talking about, and what is this profit potential? Now, profit potential, if I go to OECD, which is like the guidance, like the Bible for all of us, it does not say the loss of profit is equal to profit potential. So take an example. There was a manufacturer. We converted that manufacturer into a contract manufacturer. And we reduced his remuneration from whatever it was to a cost plus 10%. Is this a business restructuring? Answer is yes, because it has all the elements. Change in FA&R, and then we are also talking about his profit potential, which is ability to exploit the manufacturing rights, have been taken away from someone. So this is a profit potential that has got shifted. But let's say there is a software services company. It was getting remunerated on cost plus 20 last year, and we moved it to cost plus 5% this year. Is it a restructuring? Is it a loss of profit potential? Answer is no. It's a loss of profit, but not a loss of profit potential. So that is the way we have to analyze our restructuring transactions, not to jump on to say every restructuring transaction results in transfer of profits or a profit potential which warrants an exit charge. I'm sure all of you are aware of this concept of exit charge, but maybe for the sake of brevity, I'll just talk about this. Exit charge is simply to say that, let's say if somebody is trying to buy rights from someone. So take an example today. I go tomorrow to MAF and say, Mr. MAF, from tomorrow, don't do your business in UAE or in Saudi Arabia. I'll do it. What will he do? He will ask me for a compensation. And that compensation is nothing but it is your exit charge. So we as tax professionals and tax consultants and taxpayers all together, whenever we hear the word business restructuring, we tend to jump on to say there has to be an exit charge. Answer is probably no. Because there is another alternative which you need to examine and tick off before you go to this is there option realistically available? Okay. What it means is that for my continuity of business, should I have continued with this business or I stop doing this change and be out of this business? So if the option realistically available for me in my example was to move from a cost plus 20 to cost plus 15, otherwise this was not viable, then it's a business continuity issue and may not really warrant a exit charge. So whenever you are looking at these things, just examine it from this lens. Year-end adjustments, we spoke about restructuring, opening and historical balances. Rishi, you touched upon this. I'm not touching on this. Adjustments we talked about. So I think pretty much covered on this slide. Now, I just wanted to quickly touch upon a fact that this is compliance, which will be over in next 17 days. But what lies ahead of us? So as I was talking that this is becoming like a Makkah for tax practitioners where tax and tax laws have been getting introduced by the day, there is progressively, there is a thought process of FTA to say that, how do we curb litigation in this country? And being Indians, with due respects, we are prone to litigation. We love litigation. I'm sure if anybody has practiced in India, 80% of the business came from litigation, right? So the idea of introducing this APA program, which Rishi just touched upon, is to curb litigation. So APA, just elaborating a bit more, is APA is a program which encourages taxpayers to go to the tax authorities upfront without an audit being initiated and sit across the table and try to settle or agree the positions. And as the word says, advanced pricing agreement, which means you are actually sitting down on the table and negotiating it out. Now there are broadly three types of APAs that are available in the market. There is a unilateral APA where, let's say, UAE taxpayers go to FTA, UAE FTA, and settles the position to say that my policy, my process, my margins are so and so. That's unilateral APA. There is a bilateral APA which says, let's say, government of Saudi and government of UAE will talk to each other at the instance of the taxpayer and settle this pricing once and for all. And then there are multilateral APAs where UAE, Saudi, India, maybe other countries will get involved to settle this transfer pricing and the prices of transfer pricing. So we are again very, very nascent stage of APA in this region, because if you see what's the announcement that has just come is that starting this Q4, they'll start accepting unilateral applications. It's not yet done. The forms are not yet out. The process is not yet out. How many years this will be covered is not yet out. So it's law in making right now. But what is encouraging and what I'll encourage all of you to, think about is, it's a fantastic opportunity to resolve disputes. We don't have to go through the lengthy process of disputes. So start reading and learning about this, because this is a program that is globally available. If you see most of the mature countries of India, including India, by the way, just to give you an interesting stats, when APA program first came in India, the first year the number of applications that got filed was 700 cases, 700 plus. That's highest in the world. And by far, if you see the number of cases that have got resolved in APA world, that's also highest in India. Probably much has to do with the litigation that's happening over there, but that's where it is. So, and there is depth of information available on APAs. Go through this, prepare yourself so that, because once the program gets launched, you'll be able to make an informed call whether you want to go for it, how you'll advise your clients, and so on and so forth. So just brace yourself for this. Want of time, I'm not getting into details, but another interesting development that's happening in this space is with the introduction of Pillar 2, and Rishi touched upon Pillar 2. Pillar 2 is global minimum taxes, which says any income that is going to come henceforth will be taxed at the rate of 15%, provided you are within that threshold of 750 million euro as a group, and provided to all those ifs and buts that we are talking about. But what it means for this region is specifically, you think about your free zones. The income that you are going to get from free zones will be taxed under this global minimum taxes. Now, to offset some of this and also to encourage His Highness vision of D33, there is a thrust on this program to say we'll start providing R&D credits. So for any R&D that's going to happen in this region, there is going to be R&D credits that will be provided. Again, the program is not yet detailed, but it is based on UACD Frascati manual, which says globally, it's always linked with your expenditure that you're doing or the kind of R&D, that innovation that you're doing. So most likely the law will come on those lines. There is also another incentive that's being talked about, and it's announced, so it will come very soon, is if you are employing highly skilled employees, okay, highly skilled and highly talented employees, some portion of your salary, that you are spending or some part of expenditure that you're doing will be refunded back to you. Again, it can be between 30 to 50%. The law is yet in making, or announcement is not yet out, so I can't say much about it, but that's coming. So brace yourself for all of this, be updated on all of this, and for this compliance season, have a very integrated and connected thinking. As I say, the first return and first marriage is something that you'll remember for the rest of your life. My time's up. Thank you.
Thank you so much, C. Arun, for that sharp and actionable deep dive on the transfer pricing intricacies and the current UAE development as well. And that was immensely useful for everyone gearing up for the filing as well. And with that, I request our chairman, CA Jaiprakash Agarwal, vice chairman. I think he's still busy in the networking. And along with that, I would like to call one of our members, CA Sumaya Zain, on the stage to present the memento on behalf of the member and the managing committee. Can we have a huge round of applause? Thank you once again, C. Arun, and our chairman and member, C.A. Sumaya Zain. Members, our next session shifts the spotlight to an area that truly goes beyond compliance: UAE tax treaties and their strategic benefits. The tax treaties are a powerful tool used wisely. They prevent double taxation, improve capital efficiency, and create competitive advantage in cross-border businesses. But their application require not just knowledge of the text, but also the deep strategic judgment as well. And to take us through this journey of understanding treaty benefits and their real-world impact, we have with us CA Pramod Kumarji. To formally introduce, may I now invite on the stage CA Sanjay Gagrani, the Amitabh Bachchan of our managing committee. On the stage, can I have a thunderous round of applause for CA Sanjay Gagrani?
So Amitabh Bachchan and Shah Rukh Khan both are on the stage, huh?
Thank you.
So ladies and gentlemen, good afternoon. Tax and Compliance Marathon, and we know that every marathon has its champions, some with the speed, some with stamina, and some with the strategy. Our next speaker has run a different kind of marathon, a 40+ year marathon in taxation and law. From being a tax advisor to a litigator, serving over 2 decades to the income tax appellate tribunal, where he ultimately rose to the vice president, none other than CA Pramod Kumar. If regular marathoner collect the medals, Mr. Kumar has collected something even heavier than this: over 15,000 judgment authored. It's not typo, or each one is like a milestone marker in the long race of direct tax evolution. And while some of us are still struggling to run for 5 kilometers, he has run through the thousands of complex tax cases with stamina, strategy, and precision. His insights have not just stayed within India, but reached global platforms like the OECD, United States, and International Association of Tax Judges. So, as we continue our own tax and compliance marathon, it's time to hand over the baton to someone who has already completed ultra marathon in tax law. So please join me in welcoming CA Pramod Kumar.
Thank you so much, Sanjay, for your far too generous words. I'm so grateful. I'm so grateful to you, Jay, and to everyone in ICAI Dubai for inviting me and for giving me this opportunity to interact with you all. When you say I've run marathon, I look at my weight, my size, and I wonder whether I was anywhere, anytime close to marathon or even a morning walk. But then yes, it was more than 40 years ago that I qualified as a chartered accountant. After my brief stint in the practice, I joined the Government of India. I worked there for almost a quarter century as a member, then as a vice president. And in the process, I was also associated with many institutions in India and globally. And we had a part of that learning process, lateral learning process, and you learn from interactions, you learn from exhibitions. It was a great pleasure to hear Rishi a short while ago, and to Arun, and to very kind words of Arun when he said he remembers the days when he was in my court. But Arun, you have no idea about how much guilt you have given me. As I was listening to this, and I was listening to your very erudite presentation, I was asking myself, how the hell did we allow this man to get out of the courtroom? He should have been there for much, much longer. And I can tell you that when you have people as articulate, as erudite, as thorough in the legal system, arguing cases, trust me, the outcome of the judicial decisions is going to be lot better. I do miss the fact that you are not part of the Indian tax adjudication system. As a pleader, as someone who was arguing, and I'm sure when you go back there, whenever you go back, you will have a new role in mind. When I was hearing Rishi a short while ago, this was even more interesting. And he said he was making a very knowledgeable presentation. I was so happy to be here and to witness this. And the way he took you through the entire journey, BAPS period, post-BAPS, how transfer pricing evolved. But then I also realized the risks involved in learning these things and facing this in practice. In one straight sentence, he said, now there is no priority of the choice of methods that you have. The famous Glaxo case in Canada was pre-amendment in the OECD. But I can tell you that even after this priority in the method was removed, there has been considerable debate as to how do you choose the most appropriate method. And in your law also, in UAE law, as I was listening to you, I did a quick check. I said, how do you choose a method in UAE? Indeed, there's no priority. But there is an implicit priority in the sense that how do you choose a method? And what are the considerations which you have while choosing a method? And trust me, in India at least, I witnessed a huge amount of litigation on this short legal point. So what really happens in your chambers, consulting chambers, in conferences, and how do we get into the litigation part are two different stories. And today you are dealing with the UAE tax law, which is like a youngster, a child who is just born child. He will not have many health complications. Everything looks good. He goes to doctor makes good money by just looking at him, taking his temperature. As things evolve, as you pass time, complications develop. As some of these children grow as obese as I am, or they develop other health complications, then doctor's job becomes more difficult. It becomes more challenging and, ironically, more economically attractive also. So right now you are in the phase when you're looking at the basic things, and the way things will take shape now is the time when problems develop. And to a consultant, whether you are in medicine or you are in law or you are in accounting, your real value is when somebody is in trouble. And that stage is not very far, trust me, the way things are evolving and the way things are witnessed. Now, UAE is a truly global business hub. In every way you look at it, whether you look at the strategic location, you look at the environment which is business friendly, when you look at the regulatory framework, infrastructure, skilled workforce, quality of life, no personal taxation, no withholding taxes, it's all set to, it is something which is at the center of the global businesses. And you have a huge treaty network. I understand it's 142 at the last count. That's what the MOF guideline, MOF website told me. But then, today you don't have many treaty issues. Why don't you have treaty issues is because the interaction with the domestic law and the tax treaties has just not begun. It's the first year. You are just looking at the corporate filings. You are looking at evaluating those things. But as you go along, you will realize that it is this interaction of domestic law with the international businesses which sets a fertile ground for a new area, an area which you had no occasion to see in as much detail. And that area is how do tax treaties help your clients in a strategic manner? How do you, from an expert auditor, evolve into a strategic advisor, allowing your client to make the best of the international tax situations? And this transformation is something which brings to you new opportunities, new challenges. In many ways, it reminds me of what I saw when I was 35 years and of course 70 kgs less in mid-90s. So that was long ago. But that was the time when Indian liberalization had just started. And that was also the time when tax treaty matters were prerogatives of the large firms and the big fours. Beyond big fours and beyond those large firms, not many people were interacting with the international tax treaties. And then once we saw that the interaction process starts, and then even those who were not specialized into the investment structuring, they were not working in the large firms, they were not working in the big fours, they also slowly started getting involved with the tax treaty issues. And what we saw thereafter is an amazing change in the Indian scenario so far as the international tax treaties and the practitioners in international tax treaties are concerned. Today, you have a large number of people much beyond big fours, much beyond large firms, much beyond working in multinationals, who have specialized in the international tax treaties. They are practicing in tax treaties. A couple of weeks ago, I was in Mauritius, and I learned that there were 3 chartered accountants from India who were dominating the tax practices there, and not for small clients. You are looking at one of the biggest litigation you had in Mauritius, running into billions of dollars. And the expert witness who appeared there was not only a first generation chartered accountant, but somebody who was not known as much in India as much he was accepted in those areas. So we have seen the transformation, and the institute also played its role. I think Ashna was telling me when I was talking to her a short while ago that when she qualified in 2005, you did not have to look at the international taxation to become a chartered accountant. But then we saw how it was picked up by international in the curriculum. Then we saw how the programs were developed. I have been a faculty in their programs at several places. And how today an ordinary chartered accountant, when I say ordinary, every one of them is extraordinary. I mean an average chartered accountant is as much involved with the international tax treaties as those people in the big fours. But there is one major change, and that major change is also a very positive change. That change is the overall global scenario so far as the tax treaties are concerned. The era of the international tax being an exclusive club, that seems to be more or less a bygone era. We saw after 2008 crisis, when BEPS started, how was the international tax developed? How were these treaties developed? Primarily by the OECD. So it was a rich man's club which was telling the world what to do. But then we saw when G20 was involved. So just 8 more countries, and they were involved in the process of international tax reforms. It did not stop there. When the inclusive framework started, today we have 142 countries on board of the inclusive framework. And what has happened thereafter is even more interesting. Just a few months ago, we saw how the developing countries stake their claim for greater participation in the process of developing the international tax law. We are on the verge of having a stronger UN framework which works as a substitute to the OECD. So OECD, which was taken as the gospel truth, OECD, which was dominating this area all along, suddenly had to not only make way to adjust some of the peoples, to bring in the reforms, but also it seems to be also acknowledging the position that we have a situation where the international tax is to be developed on the basis of global consensus, including everyone on board. So that's a huge change. But then what do tax treaties do? How would it affect you and me? How does it affect an average taxpayer? The classical thought was that tax treaties help you avoid double taxation of an income. I would think it was a very simplistic approach, and if this approach was to be really as much of substance as it is claimed to be, then probably there would not have been any justification of tax treaties with the jurisdictions where there are no taxes. India UAE tax treaty is one such example. When this treaty was entered into 1993, there were no taxes in UAE, please correct me if I'm wrong, except on the oil companies and some banking companies, there were no taxation. And very interestingly, 20 years ago, the first major case, I would think, which I had an occasion to adjudicate upon with respect to the India-UAE tax treaty was a case called Green Emirates Shipping and Travels, if you can see it on the Google or whichever AI model you use. And what was the issue before me in that case? I still remember it was a very small issue. This Green Shipping and Travels is a small firm in UAE, probably not known for much. But then it claimed a treaty benefit in India. And the question arose that, look, you have the double taxation avoidance agreement to avoid double taxation. Here is a person who has not paid taxes in UAE at all. So if he is paying taxes in India, what heavens are going to fall? How are we concerned about it? There is no avoidance of double taxation. There should be no treaty protection. And then the question arose, what is liable to tax? That was a time, if I remember correctly, the expression used in the treaty was a person who is liable to tax, etc., etc. And those were also the days when Indian Supreme Court judgment in the case of Azadi Bachao, a very pragmatic and forward-looking judgment which has been accepted, very well and which holds the field even today, was just delivered by the Supreme Court. And the question which really was, and we also had a judgment authored by a very eminent Supreme Court judge, Justice Qadri, who was then chairman of the Authority for Advanced Ruling, who said no, liability to tax means you have to pay tax. If you have not paid tax, you are not entitled to treaty protection. I was a little pained, surprised, pained, and I wrote in that very brief order, I think my order it runs into just 5-6 pages. I said, how can we get into the debate on such a fundamental basic issue as to who is entitled to treaty benefits? The government of India had its eyes open when they were signing a treaty with a jurisdiction which doesn't have taxation at all. So, and then apart from giving my decision, which probably was that no, it does not deal with the existing double taxation, but it also deals with the potential double taxation. I also gave a suggestion that it's time that you make up your mind whether you want to give these benefits or not. And then came an amendment which amendment really took away that requirement of being liable to tax and gave a different description. That amendment came as a sequel to this judgment and to suggestion given therein. But the next question which comes to the mind is, if the tax treaties are not simply to avoid the double taxation, then what is the purpose? Why do we have tax treaties, and how, why would they be relevant? Well, there are a large number of purposes. For example, it lowers the withholding tax rates. For example, it restricts the source taxation. And when I say restricts the source taxation, I'll just take you back into the basic of this and how does it help. But before that, let me also tell you that it provides you tax credit mechanism. It provides you an even ground. It ensures that the laws which are made so far as the taxation of in the other jurisdiction are concerned, they do not discriminate between the permanent establishment of a foreign, of the treaty partner jurisdiction and the local people. And then information gathering, exchange of information, etc., etc. Now, when I was saying restricting the source right, one of the reasons why we have the tax treaties, and that's the genesis for all these treaties, is that you have a conflict of source rule and residence rule. Now, when we talk about the source rule and residence rule, fundamental principle is you are liable to pay tax where you earn income, and you are liable to pay tax where you are fiscally domiciled. So, if I'm a person who is fiscally domiciled in UAE, or let's say India, I pay taxes in India on my global income. But if I've earned that income in some other jurisdiction, let's say Zimbabwe, then because the income accrues there also, there's an equally legitimate right to tax. Now, how do you resolve these? The classical explanation is treaties allocate taxing right. The way I look at it probably is slightly different. I would think they restrict the source right taxation. And when I say they restrict source right taxation, I think that's where you come into play. That's where UAE also has a very important role, and you will see that it comes in a part of your day-to-day life. When it restricts taxation in the source jurisdiction, take for example airlines. Today airlines come, think of a country like, if we are talking Zimbabwe, let's talk Zimbabwe, where they may not have a domestic airline which really has so much of international travel. Emirates goes all over, they have businesses all over, but where do they get taxed? Do they get taxed in each country where they have an office? No. You have an Article 8 in the standard treaty which says profits of an airline or shipping company from the operation of ships or aircraft in the international traffic shall only be taxed in the source estate, in whatever wording they put it. But how do you define those profits? There will be some areas where these profits will not exactly belong to that. Take this example a little further. You have an airline which not only operates the ships in airlines in international traffic, but which also gives technical services to the other airlines. Imagine Air India having a base here, and there are certain kind of aircraft for which they help for other airlines also. Will that be covered? Yes, you have an Article 8.2, which says provision of one shall also apply to profits from pool, joint business, or other international operating agency. What is the scope of that? Can you say that technical pool will also be a pool? Which pool is that? So the parameters will have to be defined. One of the most popular idea in the most important idea in the tax treaties is about the permanent establishment. Then the question is, what is permanent establishment? Permanent establishment in simple English is the threshold of physical presence, directly or through an agent, where residence type taxation is involved. If somebody comes what you call fly-by-night people who come there on flights, go back, they don't have physical presence, then they don't have a PE. But once they have an office, there's a whole interesting line of definition about this. Now those thresholds. Now what are the areas where those thresholds are satisfied and where these are not satisfied? This would matter a lot, because unless you don't have a PE, you don't have that kind of a source taxation. So all these things will come into play, and then one of the areas is, then other areas would be MFN. If you have a most favored nation clause, a most favored nation typically says, I will give you a treatment which is the best treatment in this parity group. They decide a parity group. If anyone in this parity group gets any treatment better than you, you will also get the same. So you have an automatic implementation of a treaty provision. You are reading the Indo-UAE treaty today, but then there's an MFN clause which assures that India will not give a better treatment to anybody else than it's giving you. So if that treatment is given to somebody else, that automatically applies to you. How do these MFN clauses operate? These MFN clauses, there could be several kinds of MFN. One would be, if I give a better treatment, then negotiations will be triggered. The other will be, it will automatically come into play, or it will be dependent notification. In India, we had a recent case of Nestle where this thing was decided against the taxpayer, but this was only peculiarity of the Indian constitutional law requirement with respect to notification part. Generally speaking, as a consultant, you will have to see whether you have an MFN clause, and if you have an MFN clause, where does it take you? How does it get implemented? Another area which is a very important area from the tax treaty perspective is the area where the local laws are to be read down. Well, you have a clause, in every treaty, you have a standard non-discrimination clause. Non-discrimination clause, it has 5 broad formats. I'm not getting into those nitty-gritties. Broadly speaking, first thing is you will not discriminate anybody on account of nationality, on account of stateless persons. You will ensure that the PE is not any less favorably treated than the domestic enterprise in the same area. Then you have ownership non-discrimination, and then you have deductibility non-discrimination. Today, for example, if you have a non-discrimination provision in a tax treaty with a country which is standard more or less on the OECD format, then as a result of that non-discrimination provision, some provisions of the UAE laws will have to be read down to the extent they provide a discriminatory treatment. One of the simplest examples, a friend of mine, I forget his name, I'm just missing his name, Hasib. Hasib mentioned to me about the small business relief mechanism in UAE, where if you have that, we have the turnover up to a limit, and then you don't get, you have a special tax treatment for the first 3 years. Now, this is something which is given only to the residents. Now, what happens to non-residents? Do you think it somewhere hits the provision of the non-discrimination requirement? I'm not aware of the nuances with domestic law, but as I saw in the FTA document itself notes that depending on the non-discrimination provision, the application of this may have differential impact. Now, assume a situation that non-discrimination provision that you have in the respective tax treaty is the kind of non-discrimination provision which would hit you. Now, how, in that case, does a non-resident also get covered by the Small Business Relief Act, Small Business Relief Mechanism? This is something interesting. But then what are the lessons we learned from India? In India, we saw non-discrimination provisions in various forms. We saw, for example, the first kind of the non-discrimination, the first stream of judgments I saw was where almost similar situation. In India, you have 80 HHC. It used to be those days, 80 HHC and 80 HHE. That was, if you export software or you export goods, then you get certain benefits which are by virtue of the scheme of section, but the eligibility was confined to residents. This question came up in the tribunal. I had the occasion to deal with this way back in 2006, I guess, where I decided against the taxpayer. I gave a long lecture on how do you need we have to see that the discrimination is not a differentiation and discrimination, the line of demarcation I tried to draw, which probably you would draw in support of the same provision. I said, no, you need to give it only to the domestic, only to those who are resident for these reasons, and this makes sense that differentiation is done. The matter traveled to a larger bench, and the larger bench said, no nonsense. If this is the treatment we are giving to a resident, we cannot give any worse treatment to an PE of a non-resident who is doing the same business. I think Rajiv Gurnani's case, where special bench said, no, we have to read down the law. Law says that this will not be, a non-resident will not be entitled, but because of the application of the non-discrimination clause in the treaties, this will have to be allowed. Similarly, you have a non-deduction with respect to the deductibility. In Herbalife case, the matter traveled right up to the High Court, and Supreme Court simply dismissed. Same question arose. If you don't disallow a payment made to a resident because tax is not deducted at source, how do you deny deduction to a non-resident? Indian court said, yes, you are right. The provision is to be read down. Post that, amendment was made in the section, and 40A IA was introduced. That's another story. Thirdly, ownership non-discrimination. What happens in a case where you are discriminated only because of the foreign ownership? That was, I think, 2008 or 9, there was one judgment I wrote from Pune benches. And that issue in that case was a fairly simple issue. The issue was that a merger took place between Daimler and Chrysler. And as a result of those mergers, some losses, the question arose whether these losses can be carried forward or not. But the way section was worded, the company was required to be listed on an Indian stock exchange, notified stock exchange. Now a German company cannot be listed on an Indian stock exchange because of the technicality of reasons. And the tribunal came to the conclusion that no, this law is to be read down. Because today, just because somebody, a foreign treaty partner, is holding the investment, that person is put to a disadvantage. The other issues which come up, which will come up before you, will be with respect to the interplay on the credit mechanism, on how do you give the credit mechanism. Until now, it was not relevant because you were not to pay taxes in UAE, so it did not really matter whether you get tax credit or not. But today, it matters. And there were some problems which really arise. I saw in a very recent case, not a very recent case, in 2021 case, in Amarchand Mangaldas, it's a very well-known law firm in India. They were giving businesses, they were doing some work for Japanese company. Japanese company deducted tax source, treating the legal fees as fees for technical services. But as you are aware, I'm sure, that the tax credit is available only when the taxation abroad is done as per the scheme of the treaty. And the assessing officer said, no, this is not the scheme of the treaty. This should have been treated as independent personal services. The question then arose, how do you treat these situations? Of course, I wouldn't get into these fine details, but one simple thing I can tell you is that the conclusion that the tribunal arrived in this case was that no, it's a reasonable interpretation. It may not be exactly the same way you think, but as long as it's not perverse and something which is not worth looking at or wholly unsustainable, then this should be accepted. And the credit was given. Airline situation, I just dealt with you, just briefly explained to you how do you define those contours of the permanent establishment. And now, apart from permanent establishment, you will also have to see that how do you see those definitions of the source right restrictions? How do you decide that whether it's covered by the clause or not? And when you deal with these things, you also have to bear in mind the domestic laws of the respective jurisdictions. Very recently, there was a case, I think earlier this year, what you call hot bread Mahadevan case, which was quite in news. And one of the interesting issues, and that gentleman was a tax resident in UAE. He was a person who had a residency certificate, and the issue arose whether this person is to be treated as a resident or a non-resident. There was a whole debate on this. But as I was reading that judgment and I was looking at the analysis thereafter, I found something very fascinating. And the fascinating thing was that under Indian law, if you are, whether you are going out of India for work, then also there is a requirement of 182 days. And when you are visiting India, then also requirement is 182 days. So, but there is a C difference. C difference is that when you are going from India and going for the purpose of work outside India, you have to demonstrate that you are going for the purpose of the business. But when you are coming and you are visiting India, then you don't have to demonstrate that you are outside for work. And that again, these are the little nuances. There is a ruling by Delhi Tribunal which says that when it comes to the residency part, you don't look at the economic attachments. You look at the number of days spent. So I would imagine if this person had claimed, and this case was rejected on the ground that there's no evidence to show that you were out of India for work. But I would imagine if he had said, no, I was visiting India. I was not going out of India. Then situation was entirely different. Then he was not required to show whether he was there for work or not. I wrote an article on this. To live in India or it was something like, visiting India or living in India. Dilemma of a globetrotter. This was on the Tax Sutra portal. And then we saw how little small change, it makes so much of a difference of a person. And difference is, there's an entire global income is taxable or not taxable. So you will see that all these small nuances that you talk about, these make a lot of differences. Then you have some treaty peculiarities. When you look at India-UAE treaty, for example, something as mundane as other income. And remember, when we talk of other income, it is not to be mixed up as income from other sources in India. When you look at other income in tax treaties, it is only an income which is not covered by any of the preceding clauses. Now in Indo-UAE treaty, other income is to be taxed in the country in which you are fiscally domiciled or resident, to put it frankly. There was one interesting case which I heard shortly before my retirement, and the case was this. There was one gentleman, again a Rajiv, I don't know, I have such a fancy for Rajivs. So this gentleman bought a house in Bombay, and as was practiced perhaps in those days, he paid some amount as an on money, unaccounted money. And the person to whom he paid on money, he was visited by some guests who belonged to the income tax department, so they took away all the details also, including the details of the cash he had paid them. So the question was, look, you have paid the money, now look at section 69, this is unexplained investment, pay taxes. And then you suddenly realize that no, this is not an income which is covered by any of those treaty clauses, so it falls in the other income. And the moment it falls in the other income, it can only be taxed in the treaty in the country in which you are fiscally domiciled. So this gentleman got away from the taxation in India only on the ground that right or wrong, we don't get into the question, those things will go later. As of now, this is an income which belongs to the other income part, which is not really taxable here. Then you see other situations. For example, when you have acquisitions, when you acquire the companies, and you pay for shares which is much below the quoted rate in the stock exchange. Now, ironically, when we look at the Indian mechanism on how these are to be valued, we look at section 56(2)(10) read with 11 UAE, and it takes you to the price at which they were quoted. If the shares are given at a price less than the price at which these are quoted, then these are considered to be your income. But then I am aware that some people route that through UAE. Because, and what the mechanism would be that even if I'm paying you below the quoted rate, assuming there's an income, this again gets into Article 22 part, so you get out of that part at all. There will of course be new challenges. Can I take another couple of minutes? Now there are new challenges, and those challenges are, earlier we had limitation of benefit clauses, but now you have GAR, PPT. Now, these tests also are subjective tests. GAR is a serious business, and I'm sure in UAE also you have GAR. India GAR is being implemented. But remember, all these tests, whether it's principal purpose test or the GAR, these are essentially the tests to ensure that there's no abuse. And when you justify something on commercial consideration, these are essentially based on a narrative for what was the justification. And your assessment about what is acceptable and what is not acceptable. You have to give a justification, you have to articulate that. You have to put it out in a manner that, look, this is a justification I have. It is not a tax-driven transaction. Now, what is acceptable and what is not acceptable, how do you draw that line? And that is where I think your role is very, very important. You not only require your knowledge, but you also require that wisdom and experience to understand as to what will work and what will not work. We have seen it very recently in a much talked about case in India, Hayat ruling. I'm sure you would have read about it or talked about it. What was the Hayat ruling situation? That again was a situation where Here's an American company which comes to UAE, forms a company, they enter into an agreement, and they claim it to be a fees for technical services. Now, fees for technical services in Indo-UAE treaty, there's no provision for fees for technical services. It gets into the residuary clause. The moment it gets into residuary clause, it is taxable only in UAE. UAE wasn't taxable anyway, so you have a double non-taxation. But then the documentation part, and that's where each one of you, who is the best person to know what exactly your client does, has an important role to play. How do you do the documentation? How do you build that narrative, justifying that it is what it is? And in this particular case, all the judicial forums across the board, right from the DRP to the Supreme Court, they came to the conclusion is that no, what you are saying is not really correct. It is not fees for technical services. You are running the business. I'm not getting into the question of whether the decision was justified or the decision was not justified. I'm on a broad question. And the broad question is, on what basis do you come to this conclusion? And when you think of that basis on which a conclusion is drawn as to whether this forum, this description of the contract is exactly what it is stated to be, that essentially is a narrative and an expression which you help play. And therefore, the role that you play in every way you look at is extremely critical, and in the days to come, when we see this landscape evolving and we see how your role from an auditor to an advisor, and because you are the person who are handling these things best. There are things, sometimes some patients, I have a cousin who's a doctor who tells me, my patients play games with me. They don't tell me what the problems is. They want me to judge it. So I think chartered accountants face it every day. Clients don't tell them the truth. They want chartered accountant to understand what the facts are and then give the advice, but I would not confess it. You know it the best. And therefore, whatever be this evolving landscape on the tax treaties and its important critical role in the times to come, I think you have a very, very important role to come. And I would urge each one of you to think about it, to look at the tax treaties. Sometimes people say, I was talking to someone a short while ago, we said, oh, there are so many tax treaties, how do I read each one of them? Trust me, they are the same. They are minor differences. They are very minor differences, and you are very fortunate to be in very interesting times. We are in the times when these rules are being rewritten. Everything is being redefined. Please have your contribution in these interesting times. Take a look at this, and I'm sure ICAI, which is doing an amazing work in spreading that knowledge and education anyway, will hold more programs, more specific programs, unlike this very general session, where they take you to the nuances of those treaties, and I'm sure you will love going through this. Thank you very much for being so patient. Thank you.
Thank you so much, Pramod Saab, for such a master class on the strategic applications on the tax treaties, and the way you combined your judicial experience with the practical insight has truly given us a new lens to look at the cross-border taxations. And I'm sure that every member has taken away not just the knowledge but the clarity as well to applying the tax treaties. And with that, now may I request our chairman, CA Jaiprakash Agrawal, our executive committee member, CA Sanjay Gagrani, and along with that, one of our members, CA Abraham K. Matthew, to come on the stage and to present a memento on behalf of the ICAI Dubai chapter and the committee. Whenever we are giving the mementos, it's needless to say we need a thunderous round of applause for the speaker, please. Thank you, CA Abraham, sir. And one more time, thank you once again, Pramod ji, CA Sanjay Bhai, and of course our chairman. So moving to the next session, I think we all are waiting for that session. So as we are moving to our final technical sessions of the day, we turn to a topic that is on every professional's desk right now: corporate tax return filing. With the first filing season in the progress, even the smallest oversights, whether in the disclosure, documentations, or the reconciliations, can have the significant consequences. This is the moment where the accuracy and attentions to detail matters most. And our next sessions will walk us through the key things to remember while preparing and filing the corporate tax return in the UAE, ensuring compliance and avoiding costly mistakes. And to formally introduce our speaker, CA Atish Shah, may I now invite on the stage our executive committee member, very energetic and dynamic, CA Dikshit Jain on the stage. Ladies and gentlemen, can I have a huge round of applause for CA Dikshit?
Good afternoon, everyone. Good afternoon. I'm sure we had a very long breakfast today, so everybody is full. So can we have a louder good afternoon? Wonderful. So today is a day where we are all into a marathon, and tax is actually a marathon, not a sprint. And I think since the morning we have come to this particular venue. It's, as Jaybai said, it's homecoming. So I was not aware that 10-15 years back we used to do a lot of events here. But I'm very fortunate to be here today amongst a lot of veterans who have joined in because of the old memories. Before I introduce our next speaker, let me ask you this question, that how many of you have got audits from FTA for the VAT or excise or anything else? Any companies or anybody who's got FTA audits? Quite a few. So today we are fortunate to have a person who has actually come to audit you. So you can actually catch hold of him because he's the guy who came and caught you. I mean, not caught you in a long way, but caught your company to be audited. Today we have with us CA Atish Shah, who has more than 17 years of experience into tax leadership across GCC and India. He has done a large-scale transformation and he's currently heading the tax function at DP World GCC, where he is overseeing 40 entities across multiple jurisdictions. Earlier, he was a senior tax audit lead at UAE Federal Tax Authority. So that is why I asked, anybody got an audit? He's the guy. Where he was involved into more than 600 audits, appeals, and penalties, along with contributing key legislative review of corporate tax, VAT, excise, and tax procedure law. With decades of experience with firms like KPMG, Dhruva, LeasePlan, Emirates, Atish offers comprehensive 360-degree perspective. So with all his experience, today I'm sure we are going to get a lot of insights into how these tax laws are being reviewed, how the corporate tax filings will be done, what exactly the authority is looking when you are actually filing your corporate tax, what mistakes not to make. So I think we are going to have a fantastic session with this. So with this, can I have all your very big round of applause to invite CA Atish Shah on the stage, please. Thank you.
Hello. It's not working yet. Hello. Good afternoon, everyone. Thank you for that introduction. Yes, you might have had FT audits, but that was probably a few years back. I was fortunate, and just want to share an anecdote with our chairman and everyone from the fraternity, that while the corporate tax law was being drafted, there is a contribution of an ICI member in that. So we should all be proud of that. I was the only chartered accountant to have had my name in the CT drafting legislation. And as I represent our community here, I think we've had wonderful sessions leading up to this. And as everybody was mentioning about marathon, I think we all know the last part of the marathon is usually where you're drained, you've given your everything, but it's also the most important. Because if you don't run that, you will not finish the race. So I wanted to get started with what is important right now, and it is a corporate tax return filing. All of us have been mentioning that, we have 17 days or 18 days. Practically, we don't have so many days. Why? Because we all know the nuances of MR Tax portal. You may know that in the history, the portal has been overburdened with a lot of submissions. It has resulted into lags, delays. A lot of you might have drafted your returns and it got deleted. It happened to me, so probably would have happened to many more as well. So the key is to get started early. I mean, if we are on 13th of September and not open the portal till date, I think today may be a good time that we go home and open it. So without further ado, I think I'll get started with my session in terms of how do I move forward with this slides. Anyone can help me? Okay, this is, okay, this is help. How does this work? Okay, thank you, got it. So there have been certain updates on the portal. Everybody knows about updating the business activities. What followed after that was the email address verification and the mobile number verification. That just got published overnight. That created a lot of issues for people having one email address for about 50 odd entities. So that again happened recently. So that needs to be done. Then probably we'll get into the landing page of MRI Tax portal where we have our CT returns page where you have to click on your corporate tax, go to taxable person. If you want to amend any details, please do that. Now is a good time because FTA takes a lot of time to kind of approve that. Taxable person amendments have been delayed. It's okay if I can hold this. Is everybody able to hear me, right? Okay, I'll hold it as far as I can, then probably let's see how it works. Okay, so this is probably the landing page of MRI Tax that you guys must be familiar with. In terms of corporate tax returns, I mean, we tried to break it down in the sections or the schedules. When I say we, I'm not referring to FTA, but we as a cohort today, let's go into the sections and schedules that we have. The first one is the taxable person details, which is taxpayers details. It will have your business activity, residency, and everything. Schedule 2, you'll be asked to fill in a lot more details about qualifying free zone person. Then you have Schedule 3 and probably 6, which leads to elections and reliefs. You have a Schedule 4, which is your accounting schedule. This is the place where we will fill in details how they're reflected in our accounting statements. This is not your tax P&L. Then you have Schedule 5, which is accounting income and exempt income schedule. You have a Schedule 7, wherein you'll do your accounting adjustments such as the disallowances, entertainment, donations, and etc. And then you have Schedule 8, which is your tax liability and tax credit. And there is a review and declaration page on Schedule 9, which you cannot print to PDF. So that is another problem. I hope it'll be solved soon. I've been told it will be. And you will be able to get a PDF copy of your returns. Not probably before 30th September, but that update should come probably in beginning of the next year. So this is probably the summary of your CT returns. Now, when we are going to the journey of the filing returns, what we need to look at is, what is the type of taxpayers do we have? Do we have a free zone person? Do we have a non-free zone person? Now, let's assume for this particular session today, we have both, right? We have somebody who is taxed at 0%, and then, when the time comes, we'll shift to a 9% entity as well. So let's talk about the free zones first, because that's the first schedule that comes when you select that you're a free zone person. Is free zone really a free? We'll talk about it in the next slide, but what are the requirements of claiming a qualifying free zone person benefit? Towards the end of the filing, probably we need to check whether, is a taxpayer that you're looking at has finished the audits. Most of us have suffered at the hands of auditors when the audited financials have not yet been signed and finalized. So let's check as a checkpoint whether the financials have been signed or not. Let's get that out of the window. Then we have a local file, master file preparations and disclosure form preparation for transfer pricing, TP documentation as we call it. So again, our colleagues previously explained about what kind of TP documentations are required. So do we have that in place? We need to check whether all transactions are at arm's length or not. So there are conditions for claiming a qualifying free zone person benefit. These are conditions which we just spoke about, has two more layers to it. Income and substance. Now, each of these conditions will play a role in your CT returns. We'll talk about in a bit. So income is an objective test. What is your activity? What are you doing? Are you doing a qualifying activity? Are you deriving a qualifying income? And is your non-qualifying income within the de minimis threshold that is being set at 5% or 5 million, whichever is lower? So we need to check that. We need to have a calculation ready, and that's one of the complicated computation to be made. Reason being, there are elements of income which needs to be removed from the calculation of de minimis. We'll talk about that also in subsequent slides. Then we have a substance requirement in terms of claiming a qualifying free zone person benefit. It does talk about having your core income generating activities in the free zones, you have adequate operating expenditure, you have adequate employees and assets in the free zone. So these are few conditions or substance requirements or income requirement that are there to claim a 0% benefit, and all of them have a role to play in your corporate tax return filing. Okay. Now, while you're doing that analysis, maybe for some of your clients or yourself, if you're an in-house professional, you'll need to look at whether is it worth claiming the 0% benefit. Is it worth going that route of ensuring the compliance, ensuring the audit financials? What is the risk of not doing it versus the rewards of doing it? So each business has to do that. If your income is less than 375,000, for example, if you mostly derive a passive income of exempt, for example, or if you're a loss-making entity, definitely you need to look at it from a perspective whether do you really need to make an election to be a 0% entity, or do you have to make an election to be a 9% entity. If you are opting out of 0% regime, of course, it's a more simplified regime. You don't have to that strictly comply with the documentation bit. But then there are challenges. Of course, your income will be taxed if there is any in future. One of the perils of being in a 0% regime is that your tax losses don't get carried forward. So if you are a business who are incurring tax losses and you expect them to continue for a few more years, maybe it is worthwhile to check whether should you opt for an election and pay at 9%, utilize that loss in future, or transfer it to another related party, which is also available. So that analysis should have been done by now, or could be done even now, considering we still have about 2 weeks for return filing. So opting out has its consequences. If you opt out of the free zone regime, you opt out for 5 years. But if you claim a 0% for first year, you can opt out next year, and so on and so forth. So this is as far as the free zone concerns. Let's assume that you are a free zone person, you've selected that free zone person benefit. Does it mean that you don't pay tax at all? No. So there are certain transactions on which you still end up paying tax, and the calculation of that is very critical. If you are deriving an income from a commercial property that is located in the free zone, and the customer is a non-free zone customer, then you still end up paying tax. There is no benefit of 375,000 as a normal taxpayer. You'll not get that benefit because this is specifically carved out. You pay tax on that at 9% from Dirham 1. Then let's say if you are a free zone person who has a non-commercial property. A lot of free zones have accommodations, staff accommodations, because there are ports where the staff laborers need to stay. And if you own one of that building and you're providing that staff accommodation, which is a non-commercial property for CT purposes, then again, that income is subject to 9% tax. It does not get included in your de minimis calculation. If you are having a mainland property, and this is where it gets very, very critical, because mainland, having just a property in mainland may create a domestic PE, but do you really have a substance to carry out that business in the mainland? I mean, the authority will, just because you have 2 buildings in UAE mainland and you're deriving rent from that, the authority may not allow you to carve out your free zone into a free zone and a domestic PE if you don't demonstrate that there is a substance that is deriving your income in the mainland as well. So whoever has those split of free zone income versus a mainland 9% domestic PE related income needs to be very mindful that the substance requirement just doesn't stop at free zone. Because by definition, you're treated as a free zone, so the substance is automatically extended to your domestic PE as well. So that's a key point that we should be mindful of. Feel free, if anybody has a question, probably we can take it at the end. I'll just run through it. Okay, Now let's come to the returns. In terms of the computation, we all have seen the MRR tax computations on the portal. They may not seem to be that friendly to begin with, but they are, they've tried to explain with an I button every time, there is some sort of requirement to give more guidance. So a free zone schedule has a lot more information to put in compared to the normal other business income schedules. So there are about 10 revenue items that you need to put in. There are 2 related to employees and there are 6 related to your expenses. The revenue ones are critical. Why? Because each and every item you see on the screen, color-coded in green will have an impact on the calculation of your de minimis threshold, which determines whether you've breached that threshold or you're still within the threshold. So you have a total revenue, you have a total revenue attributable to domestic PE, and then you have those carve-outs from the de minimis, like immovable property located in the free zone where your customer is a non-free zone, or an immovable property located in the free zone which is not a commercial property, or a non-qualifying IP income, so on and so forth. So once you fill in those data from 1 to 10, you will have something called as, there will be a box at the end of the schedule to say that de minimis met or not met. So pay attention to that, have a calculation ready to see whether you've met that threshold or not. Then we come to the employee's information, and why would that employee information be relevant? I mean, this goes back to the ESR regime, right? Wherein, the economic substance regulations required you to have a substance in the free zones. So this comes from there as well. You have to demonstrate substance not just through your expenses, but through the number of employees. And in my experience back in the day in FTA, when we were implementing ESR, I think a lot of big companies who have holding company structures in the free zone have absolutely failed to demonstrate any sort of substance. So it doesn't have to be a rocket science to know what kind of substance requirement are there for a small company. The law was clear, but I think what everybody was hoping that the interpretation would be much more relaxed, but unfortunately it wasn't at that point in time. I think recent times they have been much more open about accepting the substance requirement as far as the ESR regulation is concerned. But the free zone regime is extremely stringent. If you look at the wordings, the substance requirement forms a very key part of the requirements. So average number of employees needs to be there. You need to demonstrate that you have a substance. And that's one area where FTA will focus. If you have a revenue of 500 million dirhams and you have one employee sitting, then you need to justify how that one employee is generating that much revenue. It's possible, but you need to have a justification, business justification, to kind of demonstrate that it's happening. Then you also have certain expenses related schedules in your free zone schedule, which is your operating expenditure for qualifying income. You have your CapEx details. You could select an outsource provider to kind of outsource your core income generating activities. But even that needs to be provided with in your schedule. Not just that, the amount that you have paid to that outsource provider, the TRN, TIN, and how much employees that have been outsourced. So it's a fairly detailed schedule as well. So one has to be mindful of that. And then you have an EBITDA split, which is required for the distribution of the taxes collected. And then you have wages and salaries, which is your salary cost that you have paid to your employees. So these are the schedules that typically will flow in for a free zone person. If we move forward to that, and if we were trying to see what are the reliefs and elections available, we mentioned about earlier small business relief. It's actually given to the entities, resident entities who are having turnover up to 3 million and who are not part of the multinational enterprises. So that is available for them. If you select this, your tax return gets concluded in the next page. So the requirement for a small business relief is a management account preparation only. So, and you have to just enter the total revenue number. And if you're opting for the small business relief, once you click next, your return form will just summarize the details and you're good to go. There are certain other exemptions also available. You have a foreign PE exemption, You have realization gains and transition rules. So these are the elections that probably by now on September mid, all our clients or us should be knowing that whether we are opting for them or not, because a lot of groundwork for opting out for this releases should have been done a lot before. So if you're opting for this, of course, there's an information that will be required to fill in for each and every schedule of respective reliefs. Okay, there's a lot has been discussed and about transfer pricing and disclosure forms. I think two of our learned colleagues have elaborated a lot more. I will not have anything else to add from a CT returns perspective. The disclosure form is fairly straightforward in my opinion, but yes, there are transactions that need to be put in which are affecting balance sheet as well. If you see the drop-down list on the disclosure form, there is an assets and liabilities mentioned there. So that should kind of be an indication to the businesses that whether or not balance sheet transactions should be included in the disclosure form or not. And if I go back in time, one of the reasons of having the balance sheet transaction is to kind of have a record whether or not any transactions that have happened at non-arm's length at a balance sheet level, though they have not come to your income statement, FTA would want to have a look at that. So rather than them coming and auditing you, it's easy to ask you to fill the data in the Excel sheet and let an AI run the engine for them, which is going to happen. So I think this is a more compliance-driven strategy by FTA, which will probably in next 2 to 3 years of submissions of returns will have enough database to kind of see whether transactions have been reported by both the parties for related party disclosure or not. So these are thresholds I think everybody is aware of it, so I'll just jump to the next slide. Accounting schedules. Now if we disregard the free zone regime, or even if we are with the free zone regime, this particular section, this is required to be filled in. Now this has to be filled in based on your current accounting income. This is not your tax adjusted taxable income, if I were to call it. That's what PwC calls it for their diploma. Okay, so income statement has 16 line items in that, probably from your P&L. There are a few items from your OCI, and there are of course few items again from your balance sheet and related to employees as well. So you have an operating revenue field, you have an income that is specifically incurred in deriving that operating revenue. A lot of challenges have been faced to identify that expenditure which is incurred in deriving that operating expenses. Classic case, would business development would come in that or not? So there are a lot of things that once you have your income statement or a P&L, you need to kind of break it down to match the income statement disclosure in the MR Tax portal. The accounting standards that are used, even IFRS or otherwise, may not categorize your income statement in the form in which FTA is requesting us to put in here. So then there are certain elements there like salaries, your payroll cost and all of that, which should be straightforward to get. Your fines and penalties also, which should be straightforward to get. If you have any fines on account of tax assessment from FTA, that's where you need to put it. So it will not be a taxable expenditure. Then donations to a non-qualifying public benefit entity, that will go there. Again, it will get carved out from your expenses. And there is separate sections for dividends and other non-operating expenses as well. So what is key here, what I've noticed, takes most amount of time is reclassifying your entire P&L into the format in which the MR Tax portal asks you to put in. So if we were to have a simplified approach, let's have this MR Tax portal requirement of income statement and balance sheet in an Excel, and try to map your current income statement and balance sheet with these fields required, so it will be an easier exercise for you to submit that returns. There is a OCI element as well, that if there is an income or expense which will not be reclassified in future, of course those adjustments need to be put in, and it will have an impact on your income as well. Then we come to the balance sheet. Of course, balance sheet is very straightforward, very minimal information. It's the smallest balance sheet section that I've ever seen, but yet we need to put in, right? So you have assets, current assets, intangibles, financial assets, so on and so forth. Interestingly, they've also added here the average number of employees during the tax period. So this again is not just a free zone requirement. So if you're a UAE 9% mainland taxpayer as well, you will be asked this question whether how much is the number of average employees you have during the tax period. So that is going to be an option there. You need to put the number there. Audit opinion, there is also a drop-down list wherein you need to select whether the auditor's opinion has been qualified or unqualified or otherwise, and you need to mention the name of your auditors. So that's as once we are on the income statement, balance sheet, and the auditor's information. Now, this is another thing that we need to be mindful of is what happens once you've put in those details, right? So a mandatory versus non-mandatory is what we tried to kind of, come up with. So you have certain transactions or data inputs which is mandatory for everyone. So OCI transactions, yes, if you have them, you need to put it there. UAE dividends, they will ask you for the name of the entity, TRN, dividend amount. Equity accounted investments, if they have it, there's a schedule that you'll need to put in, what is the value and etc. So it's not just about, filling up your income statement. There is a step further that once you put in those details, sometimes the portal asks you to fill in a schedule corresponding to that as well. Participation exemption is a classic example. Participant exemption asks a lot more details in the schedule of participant exemption. So again, it will ask you for the name, country, TRN, whether the top line rate exceeds 9%, and etc. So all this, if you have a 9% and a 0% split, you'll have to do apportionment for everything that we discussed so far. So a key challenge that everyone faces is how do we apportion the expenses between my qualifying income and a non-qualifying income on which I'm paying taxes. There's a guidance available and I think in the free zone guide, and the terminologies used are in generic in terms of it should be a fair and just allocation. So it's in my favor, for example, if I have a mainland PE, domestic PE, who's a tax-paying and let's say BU, and I have a free zone entity who's going to be at a 0%, I would be enticed to put all my cost in the mainland entity. And that's where the transfer pricing also comes into picture. Transfer pricing treats these two entities as a separate legal entities and a related party, so the transactions between these two entities has to be at an arm's length, and the allocation of expenses that happens between these two has to be at an arm's length. So that is a well thought, let's say, a carve out that is put in the legislation as well and in the guidance that you cannot suo moto put any costs associated to your taxable income just like that. There has to be a just and fair allocation of costs. It's very critical when it comes to splitting your costs and revenues in 0% and 9%, specifically the costs. Because think about it, if you're a free zone person having a 9% entity or a 9% domestic P or a 9% income stream, the FTA is also going to be focused on how much of deduction of expenses you have taken for that 9% stream. There will be a focus on that because that has directly reduced the tax liability. Amongst other complicated things, we also have interest adjustment. Now, interest adjustment is really interesting in terms of why it is there, how it is there. So interest adjustment has been put because, of course, there is a carve out for grandfather loan because there are a lot of loans, high value loans for the businesses that have been done before the CT law came into picture. So the idea of grandfathering those interest amounts is to not penalize entities who were not aware of such restrictions that were going to come up on 9th of December. So usually the formula that works for interest limitation rule is you get a 30% of your adjusted EBITDA or 12 million, whichever is a higher. So again, there's a schedule that you need to put in your CT return, which has all the details of what is your net interest payable or receivable, what are the costs that are incurred in relation to your finances, so on and so forth. This is also available in your I think there are guides on this matter as well. So this is from the FTA, this is a guidance. So the idea behind this is to kind of come up with detailed schedule for interest limitation. So in one part you will plug in all the details about your interest expenditure. Then there is another part in which you will plug in the details of your EBITDA, and then the system should calculate or would calculate the 30% allowances or 12 million, whichever is higher. If your interest is less than 12 million, I don't think so. They might even ask you to fill in that schedule. So again, these are the nuances of having, let's say, a specific carve out for a line item that just sits in your P&L as fine as expense. But again, just that one amount, we'll need to have all these schedules behind it in a corporate tax return. So if you or your clients have a net interest expenditure, it's worthwhile to check whether it exceeds the limits prescribed here. Then we come to the adjustments on account of the tax adjustments to the taxable income. So you have a third-party entertainment expenses, you have pension contributions which are unpaid, you have donations to, let's say, a non-public benefit entity, you have expenditure that is incurred wholly to earn an exempt income, you have dividends, and etc., so on and so forth. So the key data points that are required here in the tax adjustments, we already spoke about the interest, which is from point 8 to 12, but at point 1 to 7 on the screen, they're technically from your P&Ls, which we had filled in before. So we do fill in the information at a level in the first accounting schedule, but when we come to the accounting income adjustment schedule, these amounts are required to be put here specifically so that the system will compute what was your gross income reported as per your financials and what are the tax adjustments that you've done based on this schedule, and will throw a tax, let's say a tax adjusted taxable income and a tax liability. So the journey that you will have in your CT return will start from your financials. As we discussed, the accounting schedules will be based on your financials. Then these will be your adjustments that you will be doing to your taxable income. And then in the next few slides, if there is a slide on that, we'll talk about how the tax liability is computed. So this is your classic, let's say, tax adjustment page. The page is specifically designed for that. Now, what are the common mistakes that I have seen, or I have probably done also a couple of them, is to reporting only revenue and not including exempt income in your total revenue. So ironically, there are so many places where you need to put total revenue. You need to put it at the beginning when you log in. You again need to put it at the beginning of your accounting income schedule. So which revenue should be taken? There is a guidance available, of course, but on a quick note, we need to check, we need to take the total revenue, including the exempt income. We don't reconcile our FS and our tax returns. So that is another common mistakes. Maybe we don't have tools to do it, but we should do it. Even if it's in an Excel, we should be able to reconcile our financial statements and returns properly. Not for this year, but for next year, carry forward losses is a key point. This year, what could be careful is about whether there are any other entities' tax losses that I can utilize. Or if I have tax losses, can I give it to my another related party subject to fulfillment of the requirement? So that again, another thing that we need to do. There are cases where the free zone income is classified as an exempt income. We should avoid doing that. It's not an exempt income. It's a qualifying income taxed at a 0%. So that is a fundamental difference, but of course, we don't want to make that mistake on reporting the numbers in the tax returns. There are penalties. I mean, we all are aware of FTA penalties. No need to emphasize on that, but of course, we need to be mindful that the penalties will start kicking in from the 1st of October 2025. What we could do better at this point in time, we could file early. I would recommend to file latest by 25 because the VAT returns are also due by 28th. So the portal is expected to have two types of loads for the first time. You have your quarterly or monthly VAT submissions, and you have a massive load of corporate tax returns coming in. From the data that I remember back in the day, more than 90% or maybe 92, 93% of the companies have Jan to December as a financial year. Plus, unlike other jurisdictions where the due date extension is quite possible, it's probably in the hands of the tax authorities. I think here, the 9 months from the end of the tax period is embedded in the law. So to change a law for an extension may be a stretch. So I would urge everyone to not wait for 30th September. We genuinely don't have 17, 18 days. If you ask me, my personal advice, 25th should be the final date that we should aim to submit all our returns. Where is Dipen? Yeah, we need to do that. So, including me, I mean, we have so many returns pending as well. So we should all be mindful of that. We need to create an audit trail. We need to create the record of the documentation that we are working on. We have TP records to be kept. That's a massive documentation, if you ask me. Something that was not done by the businesses before, but has to do it from now. If you are claiming withholding tax or FTC foreign tax benefit, you need to have further more layer of information that needs to be maintained. So I think these are the strategic, or let's say last minute things that we could focus on. I tried to walk you through the CT return and the requirements, and come up with the best practices that I personally think would help you. I think with that, I'll sum up my session. Again, thank you so much everyone for joining and having me. It took me 11 years in Dubai to attend my first ever ICI event, so thank you to our chairman. Thank you for that.
Thank you so much, C. Atish Bhai, for such a clear, practical and timely session. I think all the members were waiting for this session, so thank you so much and accepting our invitation. As you said, in the 11 years you are coming very first time. Our chairman is already stood. Members, we have the couple of announcement if you are leaving. Before that, please be kind enough to dispose of your water bottles, empty water bottles in the trash. And yes, the dinner will be open just right after the word of thanks. And lunch, yeah, of course, because I am also exhausted with the energy. So yes, lunch, dinner, whatever, we need the food to get some energy. So yes, you can proceed from your right side. But before that, I announce and some exciting couple of announcements as well. But yes, before that, I request chairman and along with CA Dikshit on the stage, and one of our members, CA Snehal, to please come on the stage. And I ask Yuga as well to please join to present a memento on behalf of the committee and the chapter. Can I have a huge round of applause for CA Atish Shah? Okay, so don't go anywhere, and we have the 3 raffles, 2 Gucci card holders and 1 JBL speaker as well. But before that, I would like to call someone on the stage to do the formal word of thanks. Of course, please welcome CA Yuga, our committee member, to do the formal word of thanks. Can I have a huge round of applause for CA Yuga?
Good afternoon. Very good afternoon. We as a chartered accountant love tax season. Why? Immovable deadline, endless forms, missing information, unanswered questions, last minute changes. Latest addition is late night work. From our tax audit period, now we are coming back to the same position. Am I right? All of you going to be busy in taxes and compliance marathon this month. I would like to take a moment to express our heartfelt gratitude to everyone who made this event grand success. A special thank to our esteemed chief guest, Dr. Yahya Al-Ansari, Director of Higher College of Technology, Dubai. Sir, your presence and support not only honored us, but also provided us with a wonderful venue to conduct this important event. We are truly grateful for your generosity in providing auditorium which allowed us to gather and share knowledge. To our expert speakers, CA Rishi Chopra, CA Pramod, CA Arun Saripalli, CA Atish Shah, thank you for your invaluable contribution to and your expertise, insights into complexities of UAE tax compliance and transfer pricing. This equipped us practical knowledge that we can apply in our professional journey. Each of your session was enlightening and has sparked a meaningful discussion among participants. To all the participants of ICA Dubai chapter, thank you for your enthusiasm and engagement throughout the marathon. Your active participation and willingness to learn made this event truly special. We hope you found this session is more successful and inspiring. Thank you once again. Today, I will announce you where to go for the lunch. It's in the left side. Securities will guide you because it's a little complicated to go the men's college inside after 10 years. So you can follow the security guidelines so you will reach the cafeteria. Thank you so much. Thanks for attending. Happy evening.
Thank you so much, Yuga, and you can proceed for the lunch from the left and as well as from the right as well. There is a short walk, so please don't worry. I mean, it's a just 2 minutes walk. The lunch is open just behind this auditorium. But yes, now it's time, Jai Bhai, for the raffle. So which one we should do first? The Gucci card holders or the JBL speaker?
Pani, first thing, Yuga, this is the first time you have so many audience for your vote of thanks.
Thank you,
Yeah?
thank you, Jai Bhai.
Okay, lovely. Now, what do you want to go for? How many of you want to go for first JBL speaker or you want Gucci card holder? Both you want to. Perfect. Let's go with first one of the, we have
Okay, Jai
two
Bhai, just
Gucci.
one second. Still some members, if they don't put their business card, I think this is the last opportunity. And they can come quickly in
Yes.
forward and drop their business card.
We will go with Gucci card holder. And can I have Mr. Suren Jain, sir, Mr. Suren Jain on the stage for this raffle. सर रैफल देना है गुची का कार्ड होल्डर है आपके पास दो ऑप्शन है एक आप ले जा सकते हैं एक आप बोलेंगे तो हम रैफल निकालेंगे
कार्ड डाल दूं पहले आई डिडंट पुट दैट
Give me your card, sir.
okay can we have the fish ball please
Can
please
we
bring
have,
the fish
so
ball
we are doing first
Gucci.
Okay, cool. So can we have the fish ball here? And
मिलेगा
can we have a huge round of applause for our sponsor, Young Global? They are sponsoring this raffle, and especially the Rishi surprise
Rishi around.
standing in front of me. Please come join us. Sir, I think more cards are there. I cannot see my card, sir. Let me put my card as well. Maybe I am the lucky today.
okay let's see the one who is sir अभी भी कार्ड आ ही रहा है okay Ashna come up on the stage okay let's see first one coming in आ गया है नाम आ गया सर
क्या बात है We have our winner.
हरीश लोधा अगर आप हैं और ये आ गए सर वो दिख रहा है मेरे को ही इज
Please,
कमिंग
sir, I'll just count
रैक
five,
से आ रहे हैं रसल खेमा
4. सर आना पड़ेगा 0 तक. 3, 2.
नहीं उनका बनता भी है बिकॉज ही इज
चलिए,
कमिंग
ISN,
फ्रॉम
no
रसल
worries.
खेमा सो रसल खेमा से आ रहे हैं गिव अ राउंड ऑफ अप्लॉज फॉर हरीश लोधा फॉर मीनिंग द फर्स्ट गुची कार्ड होल्डर सर ये कार्ड होल्डर कौन यूज करेगा आप करेंगे कि वाइफ को जाके दे देंगे
देखेंगे गिफ्ट के हिसाब से
गिफ्ट के हिसाब से देखेंगे थैंक यू वेरी मच थैंक्स अ लॉट
Thank you so
थैंक यू हरीश भाई थैंक्स अ लॉट
Okay.
थैंक यू सर थैंक यू वेरी मच थैंक यू कैन वी इनवाइट
JBL कर लेते हैं. I think there are some music lovers as well.
जेबीएल करना है चलिए
हाँ?
ठीक है जेबीएल करते हैं लेकिन हरी भाई को बुलाते हैं
हरी भाई. अच्छा विंडमिल से आप हैं आइए.
Please come.
वेरी गुड. ऐश्वर्या.
ऐश्वर्या
क्या बात है
अरे वाह, क्या
ऐश्वर्या.
बात है,
थैंक यू सो
ऐश्वर्या,
मच. तो जय भाई हरी भाई या बिल्कुल सर व्हाई नॉट.
हरीश लोटा का बहुत बार आता है सर
हरीश का बहुत बार आता है ये फीडबैक है हमारे चेयरमैन के पास चेयरमैन से
मिस्टर मॉइज
खामोशी मॉइज खामोशी
क्या बात?
नाम अच्छा है खामोशी
I think he's
मिस्टर मॉइज खामोशी आर यू हियर ओह ही इज
खामोशी आ
कमिंग
गए मैंने सोचा यार खामोशी के साथ में इतनी खामोशी क्यों है आ गए सर मोस्ट वेलकम
सर अवार्ड आपको दूंगा एक क्वेश्चन है आर यू मैरिड तब भी खामोशी नाम है आइए प्लीज कम
Okay.
ओके क्या
Thank
करना है
you.
जी? अमित भाई लास्ट कुछ बचा है
Of course सर एक और गुची का
गुची का बचा है
कार्ड होल्डर है. आई एम श्योर ये मेरे ही निकल
आशना
है.
इस बार रैफल्स आपने बहुत कराए हैं एज ए ट्रेजरर क्या रीजन है एवरी इवेंट यू आर डूइंग कैन आई हियर फ्रॉम यू
क्या बोलूं सर युगा भाई और ये दीक्षित भाई हर रोज कंप्लेन करते हैं मेरी वोट ऑफ थैंक्स सुनने के लिए मेंबर रुकते नहीं तो डेफिनेटली दिस इज द बेस्ट वे टू कीप माय मेंबर्स एंगेज सी
And you can see the smile on the face of Yuga for doing vote of thanks today. So many are sitting. The last raffle of the day. And can we have Pramod sir since you are here? And trust me, he is one of the regulators which I love from India. Sir, please come up and do the honors for him. Give him a round of applause. He traveled only for the reason. मैंने इनको बोला सर ये और कुछ करते हैं बोला जय मैंने I have already done that, seen it. I am doing only so that members can learn from my experience. Thank you, sir, for coming in. And the last one, the last raffle.
So you are Mr. Sushil Kumar Bansal.
Wow. Thank you so much, ladies and gentlemen and the members. This is ICI Dubai chapter signing off. I think you had a wonderful sessions and keep coming all the sessions, and we will be keep organizing all these wonderful and knowledge sharing sessions for you. Thank you so much and have a great day and great weekend. Thank you.